Welcome to my video.
We're gonna crash!
On this video, I will be focusing on the 80% Wavegenius trade setup. I essentially perfected this trade setup and formation way back in 2002, and finally applied it in early 2003. This is the most frequent trade setup I use and can be lethally accurate. I've used and nailed this trading pattern I invented and almost perfected over the past 11 years over 1,000 times, and on real trading accounts, client accounts, and on hundreds of real-time posts and email, text or messenger, live signals sent to my client base. 8 times out of 10, it's been profitable. That's 80% of the time it's been profitable. I can go on unconscious 100% profitable streaks for months with this pattern. My biggest streak without having a loss, I believe, was somewhere in the neighborhood of between 22 to 30 in a row. Not once, but several times. It sounds insane, I know, because highly paid Wall Street traders make a good living. Actually, a great living with their MBAs and licenses, only profiting 55 to 60% of the time. I've read stories of guys who profit 40 to 50% of the time, and half the time they're gambling on big 10 to 20% moves, but up and down. If you get caught on one of their down 20% moves 50% of the time, life would suck pretty bad as a trader. I can't imagine the stress because I don't trade or gamble like them at all. You probably already know that, and that's why you bought this or all the videos that I made. That is very, very stressful. But this formation that has been battle worn and proven for over a decade and is the cornerstone for my extremely accurate and potent trading style. By the way, this is the most frequent trading pattern for me, but I do have another invented pattern from 2011 that just came into prominence. The 90% trade setup. That formation is detailed on another video, which you may have already purchased. The 5-wave pattern. Impulse waves move up 5 waves if bullish, followed by a 3-wave correction. From my experience, typically in a zigzag form. What Elliott or Bob Prechter, who didn't create the Elliott wave theory but merely rediscovered it, fails to mention are the gap down, rounded bottom wave 2s with no 3-wave formation. They take the form of a U shape and are the most desirable wave 2 formation. Fast, simple. The cup and handle after the first wave. Wave 1. The first wave up or down in a new trend. Usually, I measure how far this wave goes, wait for the wave 2, and from there, it gets much easier as to how far the next move up or down goes. .618 wave 2s. The most frequent wave 2 formations I've seen that work are the ABC zigzag, 3-wave descending pattern, and cup and handle. Rarely, if ever, are flats seen in a wave 2. One big thing to note is that in the past 11 to 12 years I've studied Elliott wave, rarely, if ever, have I seen a wave 1 extension or 5th wave extension. 3rd wave extensions are the most frequent and are seen from my experience 80 to 90% of the time. Calling a wave 1 extension can be hazardous. Wave 5 extensions typically occur in stock market bubbles, and when they terminate, the corrective wave following it can be very nasty in a fast, violent wave 2 move. Wave 3 or W3, the most powerful wave of a down or up move. Usually, this wave measures 1.618 times the length of wave 1 or 2.618 times. 1.618 happens most frequently after a wave 2 low, 80% of the time, but the 2.618 variety around 20% of the time. Note, do not rely on 2.618 as a possible pattern. Always think conservatively and accept 1.618. .382 upward wave 4. The best way to stop a downward trend that has a clearly defined upward 2 and a clearly defined downward 3 that's 1.618 times wave 1 is to get a retracement that moves .382 the distance of the downward 3. This is a wave 4. Typically, if it hits that .382 number on the nose and does not exceed it by a large margin, the weakest wave, the 5th wave, would be the last part of the impulse before a bottom and a large reversal. Wave 5. Wave 5s to the upside have almost ceased to exist since the 2009 low. I've seen a 1-2-3 up into a wave 2 correction multiple times. But to the downside, it's a very powerful reversal formation. If you see this, 3rd wave down equals 1.618 or 2.618 of wave 1, wave 4 equals .382 precisely to the upside of the downward 3, and a 5th wave that's either wave 1 equals wave 5, .618 times wave 1 plus wave 3, or a truncation, look out. This is the 90% trade pattern that I've used with an extremely high success. Truncation. Pay special attention to the truncation. A truncation involves a 5th wave hitting the precise top of the 3rd wave and correcting violently in a wave 2, if not the start of a new downward impulse. 5th wave truncations to the upside are extremely dangerous and have been the downfall of my infrequent losses. This one formation is why I try to and stress avoiding the dreaded 4-5 to the upside. A 4-5 that looks like the 3rd wave, it can be very tempting. Inversely, a downside 5th wave truncation can be the catalyst for a very swift reversal to the upside. Many of my best trades have come off the crazy reversal that occurs after a confirmed truncated fifth wave. Diagonal triangles. This is another very important formation. This one formation has been the cornerstone for many of my major bottom calls. Bottoms do not end with quick, violent bursts. They form an ABCDE ending diagonal triangle on low volume with a slow whimper. When it completes, the reversal can be massive. Inversely, an upside leading diagonal can be the catalyst of a major crash. Flats. Flats typically occur in the wave 4 of an impulse formation, rarely if ever in the wave 2 position. Flats can be misleading because they can also be a trigger for a fifth wave truncation. I've seen what appears to be an ABC flat to the previous A wave support, but keep going down and a scary downside 3 on a truncation. I hate trading flats for that one reason. And the fact that this ABC formation is usually 4 before a 5 is very dangerous. Anyway, here are the two basic key formations we will be talking a lot about. These are from the Wavegenius.com Elliott Wave cheat sheet. What is a third wave? Oh, the beautiful and elegant third wave. Third waves are when everybody just starts to identify a trend and rides it all the way up. In short-term trading, the third waves are typically those gap-up rallies that trade near the highs all day and close at the highs. You know, the morning you wake up and you see the Nasdaq futures up like 40 pre-market. That is a wave 3. They may or may not be gap-up rallies, but can also be slow, sustained, long upward moves. It's wave 1, wave 2 zigzag, or round bottom, followed by wave 3. But in my trading, I'm not going for the gap up third wave. Going for is the key phrase. You don't get greedy and try to ride the entire third wave up. Third waves are not always gap up rallies. But if you see a move up that barely retraces like very minimal corrections, you could go long and try to ride the third wave up. I would consider myself a very conservative trader because I almost never try to ride a complete third wave. If I get one of those huge gap up upward threes the next morning after the initial entry, I'd be a seller intraday typically. The third wave in my setup typically would occur after the pattern. How far can a third wave go? Multiply the first wave by 1.618, add the number to the bottom of the wave 2 zigzag, and there's the wave 3 distance, or length. 2.618 is the distance after 1.618, but it only happens 2 times out of 10. Do not be greedy and think that a third wave can extend to 2.618 if you have profit at 1.618 times wave 1. Your chances of getting that are possible, but very slim. It does happen, but do not rely on it. What percentage makes me happy? Well, if you've been following my work, 7 times out of 10, I'm hitting singles, or the 1% or 2% on margin profits. 3 out of the 10 times, I'd hit the home run and ride a bulk of the third wave up, or I get a huge gap up and the entire third wave falls in my lap. But I'm content hitting singles and long streaks simply because it adds up and adds up and adds up. Mark McGwire didn't hit a home run in every at bat, although it seemed like it. He'd hit singles and doubles, and the home runs would fall in his lap. That's what I consider hitting the home run in a trade. Most of the time, you won't know unless you wake up with a huge gap of features in the morning, and it's a pretty obvious move. It falls in your lap. The zigzag. Zigzags form in an ABC pattern. A wave is the first wave down, B wave retraces 0.618 of the A wave drop, and C wave is typically equal in length to wave A. This is an 80% trade setup on a 0.786 breakout. After 5 waves down, or an ABC zigzag pattern, the 0.786 breakout occurs if the rally off the low retraces 0.618 times the length of a corrective wave to the upside. Best trades are the wave 1, wave 2, wave 3 pattern. Wave 1 followed by a corrective wave 2 that holds 0.618 of the distance from the low of wave 1 to the high of wave 1, followed by a wave 2 move that retraces 0.786 of the entire wave 1, setting up a wave 3, which is an 80% trade setup. The setup involves finding and identifying the magical third wave move, and is a pattern that occurs frequently. Finding them is the key. I call this formation the pattern, or wave 1, wave 2, wave 3, or 2 before a 3. I've run off huge, profitable streaks based on this one pattern alone. So keep this in mind. It's like a machine gun, Joe DiMaggio approach. I'd buy this pattern over and over again, grabbing singles, 2%, before eventually hitting a gap up home run of 10%, or 5% on margin. It was so successful in 03 to 04 that my trades, which were profitable 80% of the time, resulted in a real net profit of almost 1,700%. Yes, I turned an account valued at around $2540 in February of 2003 to almost $45,000 by the summer of 2004. Here's how it works. Essentially the most anal and safest way to safely buy into a third wave. But you need to have confidence that 1. The first was a real first wave. 2. The wave 2 retraces near 618 in an ABC A equals C zigzag formation. 3. You don't buy 618, maybe 786, but definitely 100 as detailed. If you feel the market is about to swell early in the morning, 618 entry is okay. But if it's wishy-washy in that area, try 786 where I usually buy, or be safe by actually getting to the full breakout. Third waves form because wave 2 is like a slingshot. It's pulled way back to try to break the low of wave 1, but when it doesn't and is weak, the smart bears cover and the greedy bears run for the hills. It gets congested in the area and panic covering kicks off the 3. Like magic, it works 80% of the time since I perfected it. Zigzag after wave 1. Notice that the A wave is equal to the C wave precisely, or approximately. Typically, the zigzag will not be that much longer than the A wave. If the C wave is much longer than the A wave, it's no longer a zigzag, and I will not trade it to the long side. Also, the zigzag must be less than or equal to 0.618 in length of the wave 1 and the retracement wave 2. If it's longer than that to the downside, I typically avoid it. So now that we've identified the wave 1 and wave 2 zigzag, at what point do we buy it? I used to buy right at the 0.618 Fibonacci retracement level in a zigzag and try to ride the third wave up. This strategy, for me at least, is obsolete, and I avoid doing this completely. Many of my biggest trading blunders have been trying to anticipate a zigzag 0.618 retracement and buying there, only to see it drop much further than I thought in a downward 3. You could place stops and percentages below the 0.618 Fibonacci retracement level, but what's the point? If you catch a third wave up, you'd miss just a fraction of it if you trade the way I would trade it these days. Here's how I would trade it these days. After the wave 1 and wave 2 zigzag to 0.618, I would wait for the reaction and rally. The point that I would buy a stock, ETF, or index is right at the 0.618, 0.786, or 1.00 pattern break. The safest bet is to buy at the 1.00 retracement. So what is this retracement? Basically, it's the distance from the top of wave 1 to the bottom of wave 2 times 0.618, 0.786, or 1.00. So if the peak of wave 1 after moving from 1 to 10 was 10, and wave 2 equals 10 to 5, take that 9-point move, multiply it by 1.618, and add that new number to the low of wave 2, and you've got the wave 3 target. This is where I typically buy and hold in a third wave attempt. We would have completed the wave 1, a wave 2 zigzag that holds 0.618, and the breakout to higher highs above the wave 1. That was my first setup. The wave 2 zigzag followed by a 0.618, 0.786, or 1.00 move that retraces the top of wave 1 to the bottom of wave 2. My other setup involves the cup and handle or a rounded bottom wave 2. Here are 5 chart examples of the power of the 80% trade setup on longer term charts with zigzags. As you can see, many of my 1.618 targets hit after this 1, 2, 3 and 0.786 breakout formation formed. On October 8th, 2013, S&P had peaked at 1730 and was correcting in a zigzag. It was threatening to get the full C wave to the downside. It had just formed an A wave from 1730 to 1675 and a B to 1695. Although it fell short of a full 618B, it was the only logical move at the time since the C started to form abruptly after breaking down. Identifying the zigzag bottom formation was helped by a VIX that was spiking. VIX got right near that level when S&P eventually bottomed on this chart at 1646. Here's the result of the ABC 1640 zigzag bottom call on the S&P. As you can see, the S&P got right near the 1640 A equals C low and found support near it at 1646. It was a powerful zigzag and reversal formation that took out 786 near 1710 after completing it, and the result is what you're seeing. Zigzags are very common corrective patterns, and the 80% trade setup would be the S&P breaks 786 and buy UPRO when it happens, setup move. This is the chart of the Forex Euro USD from April 25th, 2013. As you can see, there's the ABC zigzag pattern, which had potential for the 80% trade setup from 1.321 to 1.298. It found A equals C support and rallied, and I said that if the euro ended up taking out 1.321, the result would be a potential 3 to 1.37. What I learned about Forex is that zigzags and 80% breakout trades setups at 786 to 100 are lethal. They break out so fast on this particular pattern and are easy to spot with the liquidity that currencies can provide. As you can see on this chart from December 6, 2013, Euro USD broke above 786 after the ABC zigzag formation and spiked. It did take another dive to retest the previous C wave low, but held and eventually rocketed to my 1.37 target. On this 5-year chart from the Top 20 Tech PDF from way back in August 25th, 2010, Netties had bottomed at the low of 15 and rallied in the Wave 1 move to 47. The peak at 47 represented the 1.00 breakout level after it started the big zigzag ABC correction right to 27. A wave was 47 to 32, and the C wave was approximately equal to C after dropping for the top of the B, which retraced 0.618 from 42. Pretty easy pattern to see. Netties had just rallied off that 27 low and was approaching 0.786, the 80% trade setup formation. So calling a 1.618 wave 3 to 78 to 80 was a no-brainer. As you can see on the chart from August 20th, 2010, the call to 78 to 80 was spot on. That was 1.618 of the first wave, and it just recently hit my 78 to 80 target. It did get a wave 3 to 65 and dropped dramatically back to 37.5, but the wind behind the sails was a zigzag third wave breakout, and nature took over. On this chart of Amazon from the Top 20 Tech PDF file, Amazon had hit a low and bottomed out at 38 and had formed a big impulse to 150 before finally correcting in a zigzag with a small C. The C was approximately 0.618 of the A, which you don't see too often. But after the wave 2 zigzag, there's a wave 3, which is setting up on this chart. I gave it a 70% chance that it would be 260 or 250 in a full 1.618 wave 3. And even though it was just starting to reverse after this rarely seen zigzag formation with a 0.618 of A of the wave C, it had the pure 80% trade setup formation. As you can see in this chart, Amazon did break above 0.786 and 1.00 to form the big wave 3 1.618 move. Turns out there's yet another big round cup and handle formation that dropped it from 244 to 168. But it found another .786 and 1.00 breakout formation to finally hit the 250 to 260 range 2 years after my third wave breakout call. Wave 1, Wave 2, breakout .786 and 1.00, kaboom, like clockwork. Today it's well over that level and near 2.618 actually, but I'm content sitting on a 1.618 Wave 3 profit in full. On the Apple chart from the top 40 stocks from October 22nd, 2009, Apple had formed a pretty big and nasty zigzag, with A dropping from 197 to 118, a fake me out B wave that rallied all the way back to 193, which also doubled as a fake me out .786 break before correcting back to 77 and a full C. On this chart, I saw a big zigzag. The fact that it was within striking distance of 1.00 and made a bold call to many, but for me, routine. I called a 1.618 Wave 3 move and gave it an 80% chance to hit 400 when it was 194. It was pretty obvious to me and a no-brainer that the third wave would form. On this Apple chart that shows the next couple years, it wasn't an easy Wave 3 to ride. The fact that the flash crash dropped it to 193 didn't make it easy to swallow. But the forces of nature took over and eventually pushed it back into the Wave 3 1.618 move, and by September 2011, the target of 400 was met. And a year later, it hit as high as 700. I honestly didn't see anything that resembled 2.618 at the time, and you have to avoid thinking that each third wave would be ugh, that's good enough. On Joy Global's Now Joy Top 40 Stocks PDF chart posted on October 22nd, 2009, there was another beautiful cup and handle. You could call it a zigzag too. The fact of the matter was that was clearly in a wave 2 before wave 3 formation. It did the cup thing from 42 to 30 and did the handle thing from 42 to 35. The first wave was 15 to 42, so the fact that it had just broke 1.00 to the upside was a telltale sign that a full 1.618 wave 3 was going to form. I gave it an 80% chance of hitting that 75 target for this very reason. Another not so easy to hold or swallow wave 3 pattern in Joy Global. It did break out and travel to 58, but it took a very long time to finally develop. Traders would have gave up, but the long-term shareholders and company shareholders who held during that one-year ordeal were eventually rewarded with a full 1.618 times wave 1, wave 3 move. As you can see, it did the corrective sideways flat thing and spiked to 75 in November 2011. Here's a big tip about spotting zigzags. This is kind of a secret, but since you bought this video and DVD, I really need to point it out. It's very important. Basically, an A wave in a zigzag is 5 waves down, followed by a B wave up, which is 3 waves. Being able to figure out if the next move after the B wave is a wave 3 down, which can be costly. This will be described on a different video. Getting hit by a wave 3 down and trying to bottom fish a zigzag is a really bad idea, unless the following criteria develops. If the zigzag is sizable and does not occur on a gap down or deep fade C, and you can see an impulse forming on the C wave that's pretty obvious, you need to see this. Make sure you know that the A wave and B wave are out of the way and pay close attention to what happens to the C wave. If within the 1 minute chart you see a wave 1 down, followed by a 0.618 wave 2 up, a wave 3 down that's exactly 1.618 times wave 1, and a wave 4 up that's precisely 0.382, it's actually okay to bottom fish a zigzag. If after the wave 4 that's precisely 0.382 up, you get a standard fifth wave, there are 3 common fifth waves. That's 0.618 times wave 1 plus wave 3 down, wave 1 equals wave 5, or truncation within the C wave, and its equal length to the A wave. Get excited. This formation within the 80% trade setup doubles as a 90% setup, even 100%. It's extremely powerful. You see, getting 5 waves down and seeing them perfect and A equals C is one of the best trades you can get on my website. The deeper the better though, and it must hold 0.618 support, not 0.786 or 1.00, but 618. You can actually dive in that formation and try to get in as low as possible. The best fifth waves are not the truncation that holds the wave 3 low, but either wave 1 equals wave 5 or 0.618 times wave 1 plus wave 3. Oh, and the most lethal of the zigzag 5 wave down setup is this: spotting an ending diagonal within the fifth wave of the C wave. Don't worry, if you're a subscriber, you won't have to guess. I'll see it and alert you guys of it. Now onto the other formation, the cup and handle. This formation is more frequent on longer term charts and less likely seen on the intraday or 30-day charts, so keep that in mind. Cup and handle wave 2. This formation occurs less frequently than zigzags, and when I see it, it's more powerful than a zigzag when the third wave breakout occurs. Basically, it's wave 1, wave 2, and a big rounded looking cup, and not your typical ABC A equals C zigzag, as detailed earlier in this video. The cup drops in a wave 2, but slowly and roundly goes sideways and starts to slope up. Typically, the cup formation terminates at the top of the first wave, followed by the handle. This would also represent wave 1, wave 2, wave 3 off of the 100 breakout of the cup, thus forming the handle. The reaction is typically crazy, and typically when I see it, it gets the full 1618 treatment. On this chart from August 25th, 2010, there was a pretty massive and round cup and handle wave 2 formation that formed here, followed by a huge breakaway gap 3 in price line. That gap wave 3 is a dream of an 80% trade setup formation. I love getting big gaps on the 786 breakout of this move, and in this case, I called an easy 550 target and said there was a 75% chance of it happening in price line. As you can see, after the big round cup and breakaway gap upward 3 move on price line, it got a very tiny handle and kaboom, off it went. Within 2 years, Priceline ended up hitting my 550 target in that big upward 3. but the magnitude of that island upper 3 gap was so huge that it actually hit 1100 recently. This is a chart again from the Top 20 Tech PDF file from August 25th, 2010. This is eBay's big cup and handle wave 2 formation after the first wave from 10 to 28. It had just started to round out as a typical cup and handle wave 2 and had just started to reverse. But this formation I saw had the cup formed already, and due to the wind behind our sails, with the overall market with Nasdaq and S&P forming wave 3s, that 45 to 47 or 1618 of wave 1 was in place. It wasn't that obvious at the time, but I like that rounding cup and handle. eBay ended up breaking above 786 and 100 and forming the third wave, but not after getting those crucial breakout levels and essentially being dead money in a very sideways pattern for a full year. It finally eventually did hit my 45 to 47 target within the next 2 years. A third wave is a third wave, so when you trade it, keep in mind that a sideways move isn't a very bad thing, but can be very annoying if you're patiently waiting for the big profitable 1.618 times wave 1, wave 3 move. On this Akamai chart from the Top 40 Stocks PDF dated and posted October 22nd, 2009, you can see a rounded cup and handle formation, but it could also be described as a zigzag. But the bounce off the zigzag was very slow and round, which is even better. It just broke 786 to the upside near 22 and was sitting at 21.5. I saw this as at least a 70% breakout pattern and drew a 1.618 times wave 1, wave 3 target of 3840 based on this high probability setup. I spent the entire 2005 to 2007 period talking down and despising oil stocks in general, and I really hated SLB. So this came as a surprise to see that I had done a rare, non-biased bullish chart on this company. Funny, huh? Anyway, I did this specific chart because it had a beautiful cup and handle, wave 2 formation, and had just broken to a big 3. Wave 1 was 35 to 64, wave 2 was a big rounded cup and handle, back to 47, and 100 broke over 64, setting up the 1.618 wave 3, 80% trade setup formation. It had just started the wave 3 move, and I drew the 95 to 100 target based on the 29-point move from 35 as a wave 1. It was a no-brainer based on the beauty of the rounded cup. The handle was 63 to 57, by the way. As you can see on the resulting chart, this stock was a bitch to own and believe in a wave 3 move. Sideways and erratic for a full year after this call, but after the sideways nastiness had ended, it finally decided to form the full 3, and eventually rallied right near their 1.618 95 to 100 target. But upon hitting that target, it took a huge spill and corrected way back to sub 60. Screw you, oil! Those are the two formations that I key on. These are the two I frequently see when I set up the 80% trade. Either is A equals C, ABC zigzag that bottoms at that level and reverses above 0.786 of the particular corrective move, or the big round cup and handle wave 2 formation that also breaks above 0.786 and 1.00, setting the big 1.618 times wave 1, wave 3 move. You may think, oh wow, I'm going to make millions. Millions! Slow down and breathe. The toughest part of 1-2-3 patterns is identifying the wave 2 and trusting the wave 2, and finally having faith that there's enough congestion at 1.00 to cause an eruptive wave 3 that travels 1.618 length. Here are the problems you may run into. 1. The first wave is not a first wave and just a 4 up before 5 down, or worse, upper 2 before downward 3. It's not easy to spot, and if you aren't experienced like I am, you may find yourself chasing after B's and 2s without 3s. Layman's terms, you touch these, you're fucked. 2. You get impatient and chase a shallow wave 2, or the market has evolved quickly and likes to trick you into chasing every shallow wave 2. You have to be current with the state of Elliott wave every year, month, or second. In order to have this kind of information, keeping current with the evolvers is important. Yours truly is by far your best option. Me. I've seen this pattern evolve repeatedly over the years, and just because you think 1, 2, 3, and 1.00 is voila, think again. 3. You may run into an upward ABC. A downward B wave can be tricky and the breakout way too shallow. Imagine believing the third wave is a C wave, or worse yet, a double B wave at 0.618. Sounds complicated? To me, no. To you, if you're a beginner, yeah. Solution. Whenever you can, as a new member, please remember, patience is important and chasing is death. My guidance on Wavegenius is essentially second to none. I've executed or made signals on thousands of trades over the years, and I always pick my spots. Sticking with me and my very experienced and talented members and being involved in the Elliott Wave community, well, not many 80% and 90% traders wait. I'm the only one. I have many lifetime members for a reason, because they cannot live without me. Here are the important points for members. 1. Be patient always. These setups typically occur once every 2 to 5 days, and I will sit on the sidelines and not blindly chase things. Gaps and spikes and exciting moves like that are great, but when you don't have a second wave into a third wave, where do you get in and where do you get out? It's tough trading blind, especially if it didn't create a signal. 2. I will try my best to ride the full 1618 third wave until at least 90% of it is completed. Remember, do not get buyer's remorse if you see another couple points of upside. Buying at the peak of the 3 is not smart, and expecting a 1 in 5 2.618 move is delusional. Yes, it seems like magic, but it's not if you're stuck at the top of a 3 and staring down a huge cliff. 3. Do not anticipate a breakout and buy. My numbers and stop levels are there for a reason. Yes, there are times when I place a stop at 0.618 breakout. I will typically do this if the B wave is about to be breached. I can also do 786 of the C wave, 100 of the C wave, top of the B, 786 of the A or C in a zigzag, or just flat out 100 of the entire move. I've seen many times where my stop is 10 cents above the high of the day and it doesn't trigger. If you see a truncated fifth wave, look out. Wham! You've anticipated it, you're deep in the hole. I will place stops above 1.00 for a reason, and don't question it. If you want to be 80% profitable, please follow me carefully. 4. Remember also, this is an art form and not a science. Do not overthink, anticipate, or get impatient. I know people in this business who make 30 to 50 trades a day chasing 2 cents per trade. I call that crackhead trading. What I do has been perfected for over 11 years now. Here's what everybody wants to know. How do I predict bottoms at the exact day? Or how did I? I decided to analyze all the major bottoms since the 70s, including 1974, and I started noticing something. The spirals were very distinct. When I candlelized them, my eyes widened. Fibonacci was everywhere. I started counting from major bottoms to tops. I noticed each bottom to top was between 55 or 89 Fibonacci days, and if you blew it up, 55 or 89 Fibonacci months. It only took one time for me to see this. I spent the entire night looking at all the instances of this from the bottom of 74 to present. It happened repeatedly. It was so mind-blowing to me that I started to also notice Fibonacci number 34 appeared during short corrections. Those were the three numbers that worked: 34, 55, 89. 13 and 21 was very lazy, and 144 could be split up into 55 and 89. Since this discovery, I noticed a more frequent occurrence of 55 and 89. 55 has been happening very frequently in the past few years. However, there's a big catch. You have to be able to spot when the five-wave formations complete up or down, or when the zigzags complete up or down. Fibonacci doesn't work by itself. Combined with the Elliott wave is where you get the accuracy. It's no secret to me about 55 and 89, but it's tough for others to spot it when they can't find where five waves up or down or the zigzags complete. I hate having excess garbage information to carry around. I love to narrow things down to 1 or 2. To me, 1 or 2 is 55 and 89, and 0.618 and 0.382, or 0.786. Two major forms of technical analysis also come into play, or came into play in each of my major bottom calls: slow stochastic at bottom readings and the RSI at bottom readings. Take those two, add high put call ratios and an ending diagonal, and wham, you've seen and you predicted a bottom. Want to see something really cool? This is crazy. In 1933, the truncated fifth wave low was 50.16. In 1973, the high was 1051.7. So what, right? Divide that number by 50.16 and what do you get? 20.97. Don't forget that number. 1974 low was 577.6. Multiply that by 20.97. What do you get? 12,110.48. 2000 high was 11,723. Now think. The lowest of the low in 1933 shot up 20.97 to 1051.7 in 73. Lowest of the low in 74 was 577.6. Multiplied by 20.97, you get 12,110. See the parallel? I'm sure you do, and I'm sure you're shocked. Now, if the low of the Dow is 6,480, multiply that by 21, and you get what? 135,885. Will life parallel, and will we see 135, 886 in 3 decades or so? What or who would cause a sudden change in human awareness like the 60s? Now, more details about my trading strategies in the coming hour of this video. This is the outline of this period you are about to watch. 1. Know the trend, follow the trend, and have confidence in a long-term third wave upside move. If you have this confidence behind you, there's a good chance you will succeed in a big way trading these 80% trade setups.
We're gonna crash!
2. Do not short every day or scalp short every day thinking that we're going to top, and that you'll wake up one morning heavily short into a big market crash. This is the dream of a perma-bear, but since there hasn't been anything like that in a long time, you will continue to lose your money, and with pressure, all of it. 3. You will see a big explanation of how I used this big confidence in the trend factor into confidently firing out rapid fire 80% zigzag and cup and handle breakout trades over and over again to turn a tiny $2,540 account into over $45,000 in just 19 months, from January 2003 to August 2004. Four, the details of how each stop is placed with precision and why I place stops in exact areas. 5. The time frame of each trading day or month that strangely enough has certain sweet spots that you need to know. the main key Elliott wave patterns you need to know. Fast forward if you already know or already read this. The 5-wave pattern. Impulse waves move up 5 waves if bullish, followed by a 3-wave correction. From my experience, typically in a zigzag form. What Aaron Elliott or Bob Prechter, who didn't create the Elliott wave theory but merely rediscovered it, fails to mention are the gap down, rounded bottom wave 2s with no 3-wave formation. They take the form of a U shape and are the most desirable wave 2 formation. Fast, simple. The cup and handle after the first wave. Wave 1. The first wave up or down in a new trend. Usually, I measure how far this wave goes, wait for the wave 2, and from there, it gets much easier as to how far the next move up or down goes. .618 wave 2s. The most frequent wave 2 formations I've seen that work are the ABC zigzag, 3-wave descending pattern, and cup and handle. Rarely, if ever, are flats seen in a wave 2. One big thing to note is that in the past 11 to 12 years I've studied Elliott wave, rarely, if ever, have I seen a wave 1 extension or 5th wave extension. 3rd wave extensions are the most frequent and are seen from my experience 80 to 90% of the time. Calling a wave 1 extension can be hazardous. Wave 5 extensions typically occur in stock market bubbles, and when they terminate, the corrective wave following it can be very nasty in a fast, violent wave 2 move. Wave 3 or W3, the most powerful wave of a down or up move. Usually, this wave measures 1.618 times the length of wave 1 or 2.618 times. 1.618 happens most frequently after a wave 2 low, 80% of the time, but the 2.618 variety around 20% of the time. Note, do not rely on 2.618 as a possible pattern. Always think conservatively and accept 1.618. .382 upward wave 4. The best way to stop a downward trend that has a clearly defined upward 2 and a clearly defined downward 3 that's 1.618 times wave 1 is to get a retracement that moves .382 the distance of the downward 3. This is a wave 4. Typically, if it hits that .382 number on the nose and does not exceed it by a large margin, the weakest wave, the 5th wave, would be the last part of the impulse before a bottom and a large reversal. Wave 5. Wave 5s to the upside have almost ceased to exist since the 2009 low. I've seen a 1-2-3 up into a wave 2 correction multiple times. But to the downside, it's a very powerful reversal formation. If you see this, 3rd wave down equals 1.618 or 2.618 of wave 1, wave 4 equals .382 precisely to the upside of the downward 3, and a 5th wave that's either wave 1 equals wave 5, .618 times wave 1 plus wave 3, or a truncation, look out. This is the 90% trade pattern that I've used with an extremely high success since Truncation. Pay special attention to the truncation. A truncation involves a fifth wave hitting the precise top of the third wave and correcting violently in a wave 2, if not the start of a new downward impulse. Fifth wave truncations to the upside are extremely dangerous and have been the downfall of my infrequent losses. This one formation is why I try to and stress avoiding the dreaded 4-5 to the upside. A 4-5 looks like the third wave and can be very tempting. Inversely, a downside fifth wave truncation can be the catalyst for a very swift reversal to the upside. Many of my best trades have come off the crazy reversal that occurs after a confirmed truncated fifth wave. Diagonal triangles. This is another very important formation. This one formation has been the cornerstone for many of my major bottom calls. Bottoms do not end with quick, violent bursts. They form an ABCDE ending diagonal triangle on low volume with a slow whimper. When it completes, the reversal can be massive. Inversely, an upside leading diagonal can be the catalyst of a major crash. Flats. Flats typically occur in the wave 4 of an impulse formation, rarely if ever in the wave 2 position. Flats can be misleading because they can also be a trigger for a fifth wave truncation. I've seen what appears to be an ABC flat to the previous A wave support, but keep going down and a scary downside 3 on a truncation. I hate trading flats for that one reason. And the fact that this ABC formation is usually 4 before a 5 is very dangerous. Here's one big thing I follow during each trading day: timeframes. Knowing what happens in each of these important daily timeframes can be the difference between getting in at the low and selling near the high. Here's what I observe every day. "9:30 a.m., the opening bell. The obvious time frame of importance. Again, the stock you bought could be at the very peak at 9:30 a.m. Intraday highs are set right at the open, and if you see a large fade, try to grab the profit ASAP if you have it. Typically, if it's 1% or 2% on margin, by 9:30 to 9:32 a.m., I grab it if I begin to see the slightest fade from the highs. 10 a.m., big guy buy time. If a stock you bought survived 9:30 to 9:59 a.m. and is right at the highs set in that frame, there's a good chance it'll sustain past 11 a.m. and into 1 p.m. Eastern Time. I'd say 60-40 if this occurs. The big guy buying time can occur at this time, and economic reports are released right at this time as well. It can get dramatic right at 10 a.m. 10:30 a.m., the Wavegenius sell time. If I've held from the previous day up to 10:30 a.m. and the stock is at the high, I would usually sell right at 10:30 a.m. and wait for a new setup. Why 10:30 a.m.? Stocks can survive a sell-off up to 10:30 a.m. max typically. The very peak occurs frequently at 10:30 a.m. and I usually like to sell right at this time. If it survived 9:30 to 10:30 a.m., I'm out. One to 2:30 p.m., the big guys sell time. I'm sure you already know about this time frame, but it seems like 7 times out of 10, the big guys start the big selling programs at this time. It could be because they went to go to lunch, have meetings, or whatever, but for some bizarre reason, it just seems to happen frequently. If I've held into 12:59 p.m., I'd sell right before 1 p.m. hits. If the market or stock you own can survive this time frame, you could be sitting pretty into 3:05 p.m., big guy decision time. This is when I usually buy. Not at 3 o'clock p.m., but 3:05. It just seemed to work in all the years I've been trading. 3 o'clock p.m., the big guys could unleash a fury on the market with major sell or buy programs. I usually wait until the last second like I would on eBay when I'm bidding on something I want. I want the stock, but only if it closes at the highs in this time frame. Three 3:35 p.m. can also be very important these days because big bullish rallies have evaporated on the big dumb money guy with a lot of money lurking in the shadows. Keep in mind that this one period from 3:35 to 4 p.m. can provide the most volatile wave patterns in such a small time frame. I've seen 10 to 20 point S&P fades from this period, and placing strategic stops near 0.618 to contain your profit or minimize losses is key. Here's a biggie time frame to note: Fed meetings. Trading Fed meetings. I know people who only trade during Fed meetings and the rate announcement reaction. It could be highly profitable, yes, but if you're wrong, it could be dramatic. The move can be huge. What happens between 2:15 to 3:05 p.m. after the rate move is announced is pure insanity. The indices are very wild during this 50-minute period, and it's not a good idea to jump in during this specific time frame. My strategy is to wait until exactly 3:06 p.m. Eastern Time when the waves settle down. If the indices are trading at the highs, it would set up an upward wave 3 and I'd go long. But if at 3:06 p.m. Eastern Time is trading near the lows, I would avoid the market altogether. Typically, everything settles down by that time, but I feel more comfortable trading long side only. If a Fed meeting reaction is to the upside and it's off a third wave pattern break, it could potentially be a powerful and high percentage trade. Also, something big to note: it's knowing the seasonal monthly patterns every year. It's not an exact science, but strangely enough, it works very frequently. Here are the best and worst months to trade. Important seasonal time frame: October to April. The strongest time of the year starts in the middle of October and ends around April to May. It's been proven historically that the market outperforms the May to September timeframe. It's sell in May and go away.
We're gonna crash!
My worst trading months have been in the summer in the past decade, and my best trading months in the winter. Typically, a large percentage of my gains have come in October to December. Why? If the market is up for the year in October, there's an upward bias as a result of window dressing. The big funds want to show a great performance for at least that quarter and will buy the best stocks, typically tech leaders, to pump their portfolios and show their clients that they've been holding the leaders and the appearance that is for the entire year. The leaders can really move big time in this time period, and even buying dips can prove to be profitable. The best months of the year. The best time to trade if you're going to pick a couple months during the year is middle of October, November, and December. Again, the window dressing phenomenon helps boost stocks in this period if the market was up for the year heading into October. My huge Qualcomm trades in 1999, for example, were buoyed by the window dressing effect, and trading during this period can be almost mindless. There are times when you could simply wait until earnings come out in October and pick the best stocks with the best earnings during that month and hold until January of next year.
We're gonna crash!
The worst months of the year. August, September, and the beginning of October are bad. 9/11 occurred during September, the crash of '87 in September October, the crash of 1929 September to October, crash of 2008 began August to October. I'm not saying to go short in August and cover in the middle of October. That's not my style, since I'm a short-term swing trader. But it doesn't get easier during those months. The phenomenon. Closing of the books for the big funds occur in October, so they have to sell. My worst month of the year, but only for the big momentum names. January. The most dreaded month for me. Most of my biggest losses have occurred in January and not in August, September, or October. Why? Because of tax selling. The leaders are pushed heavily into the last day of December, and when the first day of the new year arrives, it's sell, sell, sell the leaders. They've pushed them as far as they can go, and will sell it in January simply because they don't want to pay taxes for the previous year in that year. I've seen rallies last in the middle of January, and when the earnings come out, it's sell, sell, sell on the earnings results, regardless of how good the reports might be. Before you try to enter these 80% trade setups with zigzags and cup and handle wave 2 breakouts, you have to understand this one big key thing.
We're gonna crash!
Accept the fact that we're in a true bull market and accept the trend and follow it. If you're one of those perma bears who can't accept it and spend half your time losing money trying to scalp shorts on the upside, this is not for you. Those Elliott wave traders will consistently lose money fighting a powerful uptrend because 1. We've entered a third wave as of December 9th, 2013. Not just a third wave, but the epicenter of a third wave move, a la the 3 of 3. If you don't know what a 3 of 3 is, essentially it's the most powerful move in an Elliott wave sequence and will guarantee cause faces to be ripped off, and pessimistic perma bears who can't see the clear uptrend jump out of 40-story buildings. Two, the fact is, the trend is a clear third wave. The perma bears who refuse to accept the fact that they're completely wrong and will continue to be wrong will keep shorting, thinking that one day he'll wake up with a big crash in the market. These guys also think that every corrective wave is the start of a crash, and at best, they will make maybe 5 S&P points on a small corrective zigzag. But the fact is, 60% of the time, they won't realize it's just a minor correction and will usually get squeezed over and over again. Your scalping attempts will continue to fail, and fighting a huge uptrend will make it worse. Three, these Elliott wave traders are also loyal and blind followers of Robert Prechter, and will continue to act on command from this very dangerous man. Last count, Mr. Prechter has told his followers to triple leverage short with a very high stop, from what I heard, 6 times in the past 2 years. Each time that so-called triple leverage short position is stopped out with a very large loss. Based on a triple leverage short position on the S&P futures, that's basically a complete wipeout. He's a very dangerous man, so keep that in mind. I've had many new subscribers who have told me stories of the money they lost following him, and I tell them that I can help them in a big way. I had some long-time subscribers who told me they had regained everything they had lost with Prechter, simply following my signals. Here's one reason why my trades and signals are 80% profitable consistently. I know the trend, and I've made some pretty amazing Elliott wave calls in the past few years, including this one. This is the epitome of wind behind my sails confidence. In January 2012, I saw a huge 80% trade setup forming on the 5-year chart of the S&P, Dow, and NASDAQ. I call it Dow 20,718, NASDAQ 4,900, and S&P 2215. Note, S&P was just 1355 at the time. The fact that I knew this third wave would form based on my extensive experience trading the 80% trade setup is why I don't get scared of any corrections, no matter how fast or deep it is. I know that in bull markets, the dip is always bought, and third waves form regularly in either a third wave grinder, which is a slow, gradual rise after a large gap up move, or simply a large gap up move. The trend is your friend. So when your friend is very knowledgeable and very bullish, you fear nothing, basically.
How did I beat you?
You're too fast.
Do you believe that my being stronger or faster has anything to do with my muscles in this place? You think that's air you're breathing now?
Here's the Elliott wave forecast for January 26, 2012, and which happens to be my birthday. So tomorrow I will be turning 36 years old. And I've been doing this for about 12 to 14 years. Started trading around 1998. And yeah, so I've seen everything. Anyway, I'll be doing this is an update on the long-term forecast of the Dow, Nasdaq, and S&P, as well as the NDX. And last time I had a long-term forecast, we just broke above 2720, and we're setting up for a third wave, and we got that. But on the long-term chart, it looks pretty clearly defined, at least to me. We got wave 1, wave 2, wave 3, wave 4, wave 5, and the corrective wave, or the crash wave on the European crisis, was a wave 2 and 5 waves, or 1, 2, 3, 4, 5. Or it could be A, B, C, depending on where the A ended up bottoming and where the B wave and the C wave ended up bottoming. But the C wave ended up dropping to 2298 on the Nasdaq, and then it was a small zigzag, and it looks like a perfect wave 2. So we got 5 waves up: 1, 2, 3, 4, 5, wave 2. And if you've been following my site for the past 10 years that I've been doing this, actually it's 11 years now. Yeah, I started GemXWave.com in 2001. I've been doing this for a long time, for about 11 years now. So I have a lot of experience. And from my experience, from my past 11-year experience, every time you get wave 1, wave 2, and wave 3 pattern break, it sets up a third wave. And I've been right 85% of the time when I call a third wave pattern break. So if you see me calling a third wave and you're short, be careful, because the third waves happen so frequently that it's just a no-brainer to me that this is a third wave setup. But anyway, 5 waves up, zigzag wave 2, and then we're breaking above. We're within 60 points, I believe, of Nasdaq taking out the 52-week high of 2887. And if we take that out, it'll be wave 1, wave 2, wave 3. If we take out 2887 on the Nasdaq, the highest target I have would be as high as, I believe, 4900. That'd be wave 1, wave 2 times 1.618. Tack on the 1.618 times wave 1 onto the bottom of the wave 2, and you get the target of 4900 in the third wave. So this is wave 1, wave 2, wave 3, and we actually have the pure third wave setups. And the NDX actually recently just took it out. And yeah, NDX took it out. Wow. Took it out convincingly. And there's no doubt about it that we took it out. 2440 was approximately, I believe it's 2440 was the 52-week high previously. We took that out by about 25 points. And NDX setting up for 1, 2, 3, and Ty's target half of that is 4,300. For S&P, this looks like wave 1, wave 2, wave 3, wave 4, wave 5, wave 2, and is in a small zigzag with a short C wave, ABC, and a short C wave. And this looks like a cup and handle type of move. It looks like got the cup, and then we're setting up for the breakout into a third wave. If this is a wave 1, wave 2, wave 3, which is the pure third wave setup, which happens to form 85% of the time whenever I call it, just be warned. 85% of the time. The highest target I have from the S&P, this is wave 1, wave 2, wave 3 pattern break, is 2215, which means that we're going to take out the all-time highs in the S&P shortly. When you have a January like this, which is so rare, when you have a big January like this, you start out the year like this, and people are convinced that we end up for the rest of the year in a third wave, or in a long extended bull market. And I believe this could be a very long third wave. And 2215 is something you can't. 2215 is a pure third wave setup if it's 1.618 times wave 1, and that's just a standard move. And if you take the percentage gain,
which is a double. Then you tack on 1.618 to that. The highest target would be about 3,200. So 1.618 would be 2215, and 1.618 times the percentage gain of wave 1 would be about 3,200. So those are the two targets I have. These are just conservative targets. I'm not even kidding. Anyway, for the Dow, the chart looks extremely bullish. I mean, this is the most bullish formation you can get, and we haven't even broken out yet, and we're just on the verge of doing it. The Dow is within 120 points of breaking above 12,876, and if we take that out, which will probably happen in the next week or two, probably the next week, we wave 1, wave 2, wave 3. If we take out 12,876, the highest target I have for the Dow would be 20,715. But if you take the percentage gain times 1.618 and tack it on to the bottom of the wave 2, highest target I have would be about 30,000. Around 30,000. Wave 1, wave 2, wave 3. So the first conservative wave target would be 20,715. I know it's hard to believe that, but this chart is just so bullish, it's not even funny. It's extremely bullish. This is the pattern break that I every 85% of the time I see this pattern break or this pattern develop. The third wave develops and it comes and extends to the full third wave target. And if you have the chance, just look at on my website. There's a link on the top of the page which shows the PDFs. And look at my third wave calls in the past 3 years on the wave counts that do for 40 stocks or 20 to 40 stocks. I've done it a long time. I'm probably going to do it shortly. I'm probably in the middle of the year. Actually, I should probably do it in the next week. I usually do long-term counts for the top 20 stocks that I like. And I was right 85% of the time, approximately, for the third waves. I wasn't right that it went up. I was right that it hit the targets, which is almost unheard of. Like, for example, Baidu was around 700, like, pre-split. And then I said it was going to go to 1,700, I think. I don't know. I don't remember, but you have to take a look at my history for calling third waves. These are PDF files that were uploaded onto my old website on the date, and there's no BS on those PDF files. So you have to look at those carefully, because every time I see wave 1, wave 2, wave 3 like this exact pattern, wave 1, wave 2, wave 3, the third wave 85% of the time develops. I'm talking hits my targets. And again, this chart, the Dow, S&P, Nasdaq, NDX, is so bullish, it's not even funny. And again, the highest target I have for the Dow is conservatively about 20,000, 21,000, and 1.618 times the percentage gain would be about 32,000, 30 to 32,000. I know it sounds like a joke to you. I know majority of Elliotticians are extremely bearish and they won't believe this stuff. But you have to believe it when it comes from my mouth, because I've been doing this for 11 years, and every time I do this, I call third waves like this, they develop. And there's a reason why I'm making a lot of money on my website, because I'm right a lot, and my trades are like 80% of the time I make profit on my trades, and 85% of my third wave calls develop. And this has been going on for 11 years, and I mean, I'm still kind of a secret to the trading community, but I'm pretty damn sure that to the higher ups, they know about me. So they don't ignore me when I call third waves. But the general public, they still haven't grasped the wave genius yet. They will when the third wave happens. But again, let me go back to the charts again. Dow, wave 1, wave 2, wave 3 will be highest is 32,000. Conservative would be 21,000. For S&P, I mean, we're just right on the verge of breaking out, guys. Wave 1, wave 2, wave 3. Conservative target for S&P would be 2215, and 1.618 times percentage gain would be at 3200. And for Nasdaq, conservative target would be 4900. Yeah, wave one, wave two, wave three would be 4900, but times percentage gain, which is about a triple from here. Let's see, da, 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 da. About 6,000. Just go look at your old Elliott Wave principle book and look at and the bullish third waves, and there's a chapter about percentage gains times wave times 1.618, and it's basically third waves can travel 1.618 times the percentage gain, and that's typically what happens. And that chapter is rarely visited. No one really reads that chapter because the bears tend to read the most bearish chapters of the book, and they ignore the bullish chapters. Anyway, I'll be doing a long-term update like once a month, like this. So just look out for the breakouts because they're gonna happen the next week, and then it could be a melt up for about 15 years.
S&P was just 1355 at the time, but to me, it was a very exciting eureka moment yet again. My favorite wave 1, wave 2, and a huge upper 3 pattern, which works 80% of the time, was just forming, but this time on a 5-year chart. On the long-term third wave setups video from January 2012, I had spotted this massive upper 3 pattern setup and stated that if the 0.786 or upside 100 Fibonacci levels break, we could see a huge move from S&P 1355 to 2251. People thought I was going completely bonkers. To top it off, I said there was an 80% chance it was going to happen. Basically, this wave 1, wave 2, wave 3 pattern and 0.786 breakout setup is the exact setup I use all the time to make my trades on short-term charts. Whenever I see this confirmed setup, I pretty much go nuts. Many of my subscribers know this, and whenever they see these numbers and these letters pop up, they pretty much get very, very excited. Here's the criteria. 1. The first wave is simply 1, 2, 3, 4, 5, with the 3 being 1.618, 4 at 0.382, and 5 the typical of the 3 target Fibonacci moves. 2. The second wave must be a zigzag where the A wave is equal to the C wave and the upward B travels 0.618 of the downward A. 3. The breakout into the wave 3 that would follow would need to retrace at least 0.786 of the entire downward zigzag. 4. Based on the momentum alone, I would decide to make an entry at either 0.618 retracement, 0.786, or 1.00 retracement. It's usually one of those three. 5. Place a stop a hair above the 0.786 level to buy, and whammo. Good profit, or very, very large profit. So in this video, this crazy third wave 80% pattern was developing on a long-term 5-year chart as opposed to 10 or 10-day chart, which makes it way more potent a move. With the confidence and precision that I have, I boldly called those 3 targets of the Dow, S&P, and Nasdaq: 20,715, 2251, and 4,800. As of November 2013, the S&P has traveled from the breakout pattern of 1355 to the recent high of 1808, and on its way to the 2251 minimum 1.618 target as described in that video, or 3650. But the funny thing, that could be just a start. You see, 2251 S&P is a 1.618 minimum. Over the years, since the beginning of the last century, every long-term major third wave has been 1.618 times the percentage gain of wave 1. Based on this calculation, my target would not be just 2251. On the Street.com article that was written about me in March of 2013, I stated as high as 3565. You can take that to the bank. Woo! Now to see the vintage 2003 Wavegenius or back in the day Gem X in action. This is some serious shit. The chart you're seeing is another reason I had faith in my 2002 bottom call, and another reason why I stayed on the long side of the trade from this dead period to 2004. After we rallied off the low with the Wave 1, the Wave 2 zigzag formed, and I was calling for a 1277 Wave 2 bottom low. It happened to touch 1252, bottom in a zigzag Wave 2, and break above 1502, setting up the third wave. This third wave I rode to the max, and combined with my newly discovered and polished Wave 1, Wave 2, Wave 3 pattern setup, I loaded up and traded dead tech stocks. The 2100 target I called soon emerged. By the way, this chart is so retro for me, it takes me way back. Ah, Santa Monica, California, how I miss you. You are now seeing my January 29th, 03 to February 28th, 03 Miracle Rambus trades, along with my early entry into the former penny stock that was a Chinese internet stock sensation, Sohu. The massive 7 to 17 spike that occurred in a matter of days in Rambus is the main reason why this tiny account rocketed from $2,540 to $5,998 in this 1 month period. It wasn't one lucky company got acquired triple. There were 21 skillfully made trades that one of my members, Cal Career, described as one of the most brilliantly executed series of trades I've ever seen. I'm surprised Ted hasn't come out to bow. What happened was, this 1-2-3 pattern break setup that I was tweaking in 2002 became lethal. I mean, very lethal. You can't see it on this chart, but Rambus formed this pattern 5 to 7 times in this 5-day period, and each time hit the button on every .786 break. The spike was definitely tradable. You just had to wait for the Wave 2 and .786 pattern break repeatedly until it was milked dry. I also made a strong AMAT trade during this period and discovered the Chinese internet stocks before they were all about to rocket exponentially until end of 2003. Here's how it works. Essentially the most anal and safest way to safely buy into a third wave, but you need to have confidence that 1. The first was a real first wave. 2. The wave 2 retraces near 618 in an ABC A equals C zigzag formation. 3. You don't buy 618, maybe 786, but definitely 100 as detailed. If you feel the market is about to swell early in the morning, 618 entry is okay, but if it's wishy-washy in that area, try 786 where I usually buy, or be safe by actually getting into the full breakout. Third waves form because wave 2 is like a slingshot. It's pulled way back to try to break the low of wave 1, but when it doesn't and is weak, the smart bears cover and the greedy bears run for the hills. It gets congested in the area and panic covering kicks off the 3. Like magic, it works 80% of the time since I perfected it. Now, back to the about to grow exponentially Chinese internets. That first innocent trade in Sohu was that start of a monster series of trades that I executed magnificently over 2003. I used to watch CNBC during the start of it and see some pretty massive percentage gains on these tiny techs from China. Sohu, NetEase, and Sina. But Sohu seemed to have it all. Incredible power, 1-2-3 patterns, and a quick recoveries and new highs. It was my favorite, as you can see in this Google Doc. These are the actual trades I executed on these 3 Chinese horsemen. Sohu was in the focus, but I dabbled in NetEase and Sina. 17 of the 19 trades in the sector were profitable, and some of them were home runs. Again, it was a newly polished 1-2-3 pattern break setup that did it. This is what happened to Sohu for my first trade in February 03 to July of 03. $7 to $43 in 5 months. If you're wondering how a $2,540 account could turn to $45,000 in 19 months, just take a look at Sohu. Now what you're seeing is pretty funny. Yes, those are all taser trades. Yes, Taser the Laser. Remember this guy? Super mega cult stock of 2004. I rode this bad boy over and over again in the first half of 2004. The best thing about the stock was 1. Serious momentum and violent reversals with high percentage gains daily. 2. Every zigzag would occur near the close, and the 1.00 when it broke was super violent. I mean, 9 times out of 10, a big wave 3 1.618 breakout on every 1.00 move. 3. Stupid fundamental news drove the stock. Tiny orders of taser equipment and even dumb articles on small websites filled with rumors caused pre-market activity to explode. 4. Every 1-2-3 pattern break setup would work as a T. It was a no-brainer after every zigzag and 1.00 break. Out of 17 trades, 16 were profitable. Better than an ATM machine. My first taste of cult stock Taser in 2004 occurred in the middle of March of that year. One of the easiest stocks to trade ever at the time. 1-2-3, 1.00, boom. Repeat over and over again. From $11 to $32 in just 7 weeks, post split. My 4 horsemen in 2003 were Rambus, Sohu, NetEase, and Sina. But in 2004, there were Taser, Rim, Ask Jeeves, SanDisk, and Broadcom. I had some nice trades in KKD and Juniper as well. Bottom line was this. These stocks were still pretty decimated by mid-2004, so the beta was extremely powerful. Even the worst stock on the planet, Rim, was doing well at this time, and I executed some powerful profits in that very stock. Can you believe that this one pattern formula is what I bank on? What are my 4 horsemen now? These days I try to avoid trading companies, period. Why? 4 letters. TSLA. You guys probably know why. Reason I try to avoid companies is because they are companies. I can't avoid the pitfalls of that. For example, bad earnings, bad pre-announcements, fad stocks, bubble stocks, death of a CEO, or worse yet, accounting issues. I have found 4 stocks that I'm very comfortable with, and they are not companies. You probably know what they are already. UPRO, the triple long ETF for S&P, SPXU, the triple short ETF for S&P, TQQQ, the triple long ETF for Nasdaq 100, and SQQQ, the triple short ETF for Nasdaq 100. If you don't know what these are, they are triple leverage ETFs that are the entire basket of those big indices. Basically, say S&P rallies 1% one day, that very day UPRO would instead rally 3%, a triple parallel to the S&P. Now, how great is that? You won't have those days where S&P would rally 2% and your stock is down 1%, Tesla, and you're angrily wondering out loud why your stupid company stock is down during a huge up day. That's happened a lot to me, and trading triple ETFs, you can avoid that stupid crap. You get the beta and leverage of a serious tech momentum stock in an easy package to trade. S&P goes up 1%, you're up 3%. As simple as that, and as powerful as that. One big question right now, after all is said, is this. Can this technique be applied to shorting inversely? Yes, it can, but keep in mind the overall market trend must be clearly down. Try trying to short C waves or downside breaks is very difficult in bull markets where we are now. It can be tempting to do, and every time I've tempted a good 40% of the time, I'm wrong, or some stupid random spike hits me and I cover. Trying to use this technique to go for 5 or 10 S&P points is hardly worth doing. This scalp method is very dangerous and very stupid. Yet, there are people who like to try to short 5 waves up or 1, 2, 3 down. 1, 2, 3 down can work, but at the 80% clip that you're used to seeing on the long side, no. It's not even worth the effort, and up to half the time, you'll see some big random spike that will squeeze you, and in no time, you'll be one of those perm bears that have lost their money. My record is pretty bad at doing it, so why not just avoid it altogether? That's what I try to do. But if it's a confirmed bear market, what do I typically do in a bearish wave? I wait patiently, basically. I wait until I see that wave 2, wave 3 pattern break set up to the upside before I'd reinitiate a position. But what if the bearish wave is turning into a downward third wave? This is when I'd react. If there's a clear-cut wave 1 down, wave 2 zigzag up that finds resistance at 0.618 retracement, followed by a break below the intraday low or wave 1, I'd go short, but never during the course of the day. I'd only do it at the big guy decision time frame right at 305. When there's a clear-cut inverse pattern break wave 3 to the downside, I'd react to it, only if the bearish wave has lasted 3 to 4 days minimum or just intraday for a day trade at most. As you guys should know, bullish waves are more frequent than bearish waves. Well, maybe not from late 2007 to early 2009, but in the past few years, since the 2009 bottom, bullish moves are more frequent. An alternate strategy would be to buy bearish ETFs like SQQQ, SPXU, or FAZ, and go for the big downward wave 3 move. My history of shorting isn't that good, but I'm right maybe 60% of the time versus 80% of the time trading on the long side, but I'm working on improving that. I think it's the mental aspect of it. I really despise the act of shorting because it's anti-American. On my soapbox. About stops. You may see on my website that I place a stop to buy or stop to sell. I place them on very key levels. So a 0.786 breakout would occur intraday after a zigzag, which is the 80% trade setup. A stop to buy is an order that would fill should the stock or ETF surpass that level. If I place a stop to buy at, say, 85.85 on UPRO and it's 85.01, when it rises to that level, it will automatically fill to the upside. The best thing about placing stops is the fact that you could just get lunch for an hour or two, come back, and see that your order has been filled with a huge amount of new money in there. You don't have to sit there all day trying to place quick market orders and try to trade like a complete crackhead. I'm a swing trader by style, so expect these trades to last between 2 to 5 days and see 6 to 8 stop to buys that trigger on average over the course of the month. Better yet, out of those 6 to 8 trades, based on my trading history, 1 will be a loss, and not that bad because I also place stop to sell at exact Fibonacci levels. I do not automatically place a stop to sell after filling a buy order. By doing this, you're basically chickening out and not relying on Elliott wave. I used to do this, And basically, what would happen frequently should a trade go down as opposed to up on the trigger is this. I buy, say, at 98 and it automatically drops on me, say 2 points to 96. But it drops on a zigzag formation or 1, 2, 3, 4, 5 down. I could see that formation developing, and if I had stopped to sell it, would have triggered. I would have taken my loss at 96 and moved on. But this is not how I work. I have a very, very iron gut, not because of instinct, but because of the science of Elliott wave, or the art of Elliott wave. I would have seen that it dropped 1, 2, 3, 4, 5 down to 96, see the 4 up and 5 down at 0.382, recognize the 5th wave Fibonacci level, and boom, it reverses not only above 98 what I paid, but 102 or higher. Keep in mind that not every time an order fills, there's an automatic spike in woohoo! Everybody makes money. I've seen stop to buy orders that trigger and kaboom down. But like I said, based on my experience with Elliott wave trading, I would prefer to recognize what corrective formation is forming first before chickening out and selling. What I'm telling you guys about stops is pretty important because what I said in the past 2 paragraphs is exactly what I do should that ETF I bought drop immediately after I buy it. But if I could clearly see a much bigger and more dangerous formation forming, and I could identify it as a mistake, I will place a stop to sell based on downside Fibonacci support, say a downside 0.618 Fibonacci support break. You will also notice that I will choose Fibonacci patterns to trigger these stops on. 1. 0.618 of the entire downside correction. Should the overall market have a pretty obvious upside gap and rally, I want to get in quick. 2. 0.786 of the entire downside correction. I do this 80% of the time because at 0.786 Fibonacci level, not only do you avoid the dreaded 2 up and 3 down at 0.618, but you also have peace of mind knowing that 0.786 is very, very close to 1.00, and to see 0.786 touch and reverse to the downside is very rare. 3. 1.00 of the entire downside correction. I will place a stop at 1.00 for this basic reason. I don't trust the market like I should, but I want to make money. 1.00 breakouts are almost as frequent as 0.786 breakouts trades to me, simply because it gives you a very high probability of a third wave and avoiding 0.618 and drop or 0.786 and drop. 4. One big thing about my trading as well is this. I won't place these stops at 0.618 or at 0.786 or 1.00. I will place a stop to buy UPRO or TQQQ slightly above the trigger price. So say UPRO's 0.786 breakout is 86.77. I will tack on another 10 to 15 cents on that order, so I would actually want to fill at 86.87 to 86.92 instead. That will be a stop that triggers on an actual breakout as opposed to hitting 0.618 and 0.786 and getting your ass handed to you on a downward 3. Here's a quick summary. The pattern generally occurs and is very successful in bull markets or clear upward impulses. You basically wait for wave 1 to complete and correct in a deep 2. Usually short term, it'll be in the formation of an ABC zigzag where A equals C and B equals 0.618 of the downward A. The deep 2 cannot exceed 0.618 support. Same applies for cup and handles. After the formation completes, you try to make an entry of 0.76 of the entire downward zigzag, or 1.00, to be conservative. Earlier entry could be 0.618, but that could be B up before C down. You guys, this is video evidence of when I posted the 490 to 500 Bitcoin call on TechCrunch. As you can see, this is 11 days ago on TechCrunch. This is actually TechCrunch. You click on the link, it takes you to that page where I made that call. And here's the call right there. November 6, 2013. Massive wave 3 breakout in progress. Just about to break a top of wave 1 to 500, and it was just actually 274.50. 274.50, that's when I called it. Yeah, so this is, I'm going to show you why. Yeah, this is actually TechCrunch. I got a lot of traffic from this one little comment. This one little comment was like, it's on this, yeah, on just on TechCrunch caused this gigantic explosion of traffic. But yeah, here's another one. So it says now as high as 320. Yeah, and I'll show you the chart which they posted it. Let's scroll up here really quick. As you can see, when I called it, this is the same. This article was posted that day. It was just like 274, as you can see, and just broke into a third wave. It was so obvious to me that it was 1-2 zigzag into a 3 to 1.618 target of 490 500. And they're all calling bubble, bubble, bubble. And I was like, 500. And this is TechCrunch, as you can see. That's a wrap. It all started when the first big speculative bubble popped from 280-ish to the print low of 50. I called a big zigzag bottom at 40 to 45 correctly, but little did I know that it would go from 50 to 280 to 1240. This is the actual chart from April 2013. The Bitcoin crash has occurred on this pattern. A wave was 270 to 105, retraced in a perfect B wave to 205, 207 was 0.618, and now in a C or 3. A C wave would target 40 to 45 in a bottom, or it was like a Tool Bubble Mania chart, 10 cents, LOL. I was chatting with some friends on Facebook, and the Bitcoin Bubble TechCrunch.com article popped up. I was casually curious about the chart and that headline. When I saw the live chart, my jaw dropped, like really dropped. Seeing Bitcoin go from 274, crash to 50, and rocket to frickin' 274 is pretty astonishing. I had little to no idea that this happened. The chart was showing my favorite Elliott wave pattern of all time. Wave 1, Wave 2, 0.76 break of Wave 1 and Wave 3 equals 1.618 setup on a long-term chart. By chance, I was witnessing the 1.00 breakout at the perfect time. The formula pointed to a move from 274 to 500. I was really excited to see this. Here's what I said in this chart. Zooming into the Bitcoin chart, there's a 3 of 3 appearance. If 1.618, target 377, right at the sweet spot. So later that night, I posted this chart. Upon the 274 breakout move, I saw within the pattern another 1-2-3 setup and third wave breakout move. Initial target before 490 to 500 I saw was 377 and a 1.618 wave 3. These are 2 posts from my site Wavegenius.com on November 7th, 2013, stating that if Bitcoin took out 315.5 or 321 and 1.00, it would hit 377 in a nosebleed 1.618 move. In that post, I said, setting up another 3. 377 is a crazy nosebleed target at 1.618. On this archive chart from BitcoinCharts.com, this is the result. Bitcoin ended up breaking both 315.5 and 321 and hit 377 on the nose before correcting quickly. It was a simple third wave pattern setup and easy to spot, at least for me. In this November 9th blog post on Wavegenius.com, I called this. After hitting 377, it got the wave 4 right to 0.382, and I called wave 1 equals wave 5, fifth wave, to 400, and a belch correction of 340. Note, if you ever catch me saying, uh-oh, spaghetti-o, on my site, look out below. Uh-oh, spaghetti-o. As you can see on this archived November 29th, 2013 BitcoinCharts.com chart, it got to 397, really close to my 400 target, and shortly after dropped to as low as 345. Basically, I called a 400 top before a correction to 340, and we got 397 and 345. On this chart from November 9th, 2013, shortly after it hit a short-term peak of 397, I called the following. Zigzag support would be 280, and I was looking for a break of 376 to set up 490 to 500. I was looking for 280, 0.618 support because zigzags are typically the A equals C formation, or test 0.618 support in a typical corrective 2. Note, after a 2 is a 3, and the 376.786 breakout represented my typical 80% trade setup move. 80%. On this archive chart from November 29th, 2013 on BitcoinCharts.com, you can see the result. 290 held near 0.618 in a zigzag, and Bitcoin took out 376 at the 0.786 breakout Fibonacci level, setting up the 490 to 500 move and a 1.618 wave 3 continuation, as you can see. On this blog post from November 11th, 2013, I stated that we were near the 0.786 376 breakout and called potential 3 to as high as 490 to 500 again. Again, this is my favorite short-term trade setup, and it works wonders on longer-term charts. As you can see, potential 3 to as high as 490 to 500 again. On this archived Bitcoin charts chart, you can see the amazing result. 0.786 breakout at 376 occurred, and within 4 days, the Bitcoin monster hit the 500 target. Bitcoin is so fast and crazy that these targets, they meet really, really fast. Don't be surprised to see 1875 really, really fast. On this blog post from November 18th, I saw a 2.618 target to 700 to 705, followed by parabolic move when corrected after 5 waves could be pretty huge. This archived chart showcases what happened. Yes, I did call 705 max 2.618 and it hit, but I was wrong about the high. It actually hit 900. But even though it exceeded my 2.618 target, I did say parabolic move when corrected after 5 waves could be pretty huge. And huge it was. It dropped from 900 to 450. That was a pretty nasty correction. Roar. I've made some pretty amazing calls since 2009. To be honest, it's not actually a secret, but people need me and my 1 in a million vision and artistic view of charts. It's supposed to be a science, but to master Elliott wave, you need to have the creative eyes of a master artist, as well as the precision of a surgeon. By the way, my dad is a doctor, and 5 of my mom's sisters and brothers are all doctors. I happen to be the most artistic of my entire family. I've written 17 songs, practically mastered guitar by age 18, and I sold works of art for up to $560 a piece on eBay. I don't plan on focusing on art and music to make money, but it could be a big factor with my life in the near future. This is one reason why people subscribe in droves. Also, they need me to fully validate their Elliott wave counts because they do not have the confidence, like I have, to go through with their trades. This is the greatest benefit of my website, and this formula is how many of my subscribers have made high percentage gains over the years. Knowing that I can validate what they're seeing in real time in the chat room or on video or audio is a very powerful tool in their trading arsenal. This November 2013, my profit accuracy has been 100%, and many of my third wave calls, zigzag bottom calls, which seemed nuts at the time, actually became true. Now, the history from 2006 to present. This historical perspective is how I became very confident with these 80 to 90% pattern trade setups. Obviously, having a guy master Elliott wave like this and being able to communicate in real time is, like I said, extremely powerful. Near the 2006-2007 peak, I was not a likable person. I only had about 200 visits a day to my website from about 2,000 visits a day because I went from hero in 2001 to 2005 to zero from 2005 to 2007. During that period, my trading was not bad. I just kept posting to my 10,000 MySpace followers that commodities, particularly oil, was about to crash and remain sideways for an extended period of time, like way back in the 80s. History repeats itself, and I despise the House of Cards market that was being formed. The fact that my not-so-intelligent ex-girlfriend got a $100,000 a year job at a real estate company simply for how she looked took me to the brink. Like, really to the brink. I didn't pinpoint the exact top of the market, but for a year, I kept calling a bubble in the housing, commodity, and oil markets on my crazy MySpace page. I knew it was going to crash. I knew it was going to crash. When the 2007-2008 crash finally came and the entire market came tumbling down in one of the worst recessions in history, I was validated. But it didn't matter. Nobody gave a crap about me. Nobody. I stashed all my money away from the market from 2006 to 2008, pretty much. But occasionally, I traded Forex. I actually, on record with real money, doubled my Forex.com account in 1 month in November 2008. But my main subscriber website income was practically nil. Nil. But in 2009, my business took a huge turn. Basically, Obama became president, and all my avenues of communication were mysteriously reopened on the internet. I didn't even appear on the search engines before he arrived. Soon after, in a huge eureka moment on YouTube, I saw something magical. The crash and indices were all near the huge 33-year 618 support levels. It was amazing. And the fact that we got a perfect wave 4 to 950 confirmed what I was about to predict. Alright guys, this is a video that I'm going to do that I haven't done in a long time, but This is because I've been doing a lot of research in the past day, which has been pretty eye opening for me. But anyway, if you look at the long term chart, it's clearly this is a clear cut 5 wave top. 1, 2, 3, 4, 5. As you the drop from 2000 to 2002, the recession from 2000 to 2002 was wave 4, and it retraced exactly 0.382 of the wave 3. And the rally from 2002 to October 2007 was a five wave top, 5 of 5, and now we're in a wave 2 at least. And wave 2s usually retrace at least 0.618 of the entire move. And going back to 1974 to October 2007, 35 years, 0.618 retracement would retrace to as low as 5,500 to 6,000. In the short-term charts, those are the targets based on the 1 year chart. Wave 1, that's equal to wave 5, with target as low as 6,200. And 0.618 times wave 1 plus wave 3 target would be 5,500. So the two targets I have are 5,500 to 6,000 in the Dow. I also have two Fibonacci dates. March 22nd, 2009 would be 55 Fibonacci days, and April 30th would be 89 Fibonacci days. So those two dates, I would look at a possible bottom would be Dow 5,500 to 6,000 on either March 22nd or 2009 or April 30th, 2009. These are clear-cut patterns I'm seeing here also. For the S&P, same thing. 1, 2, 3, 4, 5. Fifth wave down, target as low as 600 to 650. And yeah, that's pretty much my video. But going back again, this is a clear-cut 5 of 5 top, and we're in a wave 2 at least. This could be at least a wave A down. That's a wrap.
The upward 0.382 after a 1.618 downward 3 or 2.618 is how I'm able to spot major bottoms in the market. I use the 1.618 wave 3, upward 0.32, and weak wave 5 pattern to trade short-term moves on short-term charts. If you were to trade off of a 90% pattern like this, 9 times out of 10 that I spotted this, a profit was about to be made. This is the exact pattern from the peak of 07 to the bottom in 09. Wave 1 was 1550 to 1250, upward 2 was 0.618 to 1450, the downward 3 was a little over 1.618 from 1450 to 750. The key level that got me was the 382 from 750 to 950. I saw that, the eureka moment set in. Now the big question, which fifth wave would it end up being? Turns out, wave 1 equals wave 5, the most common.
This is the Elliott wave forecast for February 27th, 2009. This scenario right here for the S&P is an alternate scenario to my video of the bottom call that was posted a couple days ago. This is an alternate scenario. This is the ending diagonal scenario for the S&P, which is a possibility, and looks pretty nice right now because the formation is almost perfect. Anyway, this would be an A wave down. This would be a B wave, and this would be a C wave. A C wave would drop to exactly 740, which it did in the S&P. If this plays out, there's a possibility that S&P hits 740 and rallies to as high as 810. And after rallying to 810, it would drop to as low as 675 or 650 in an E wave. That'd be A, B, C, D ending diagonal. This would be A, this would be B, this would be C. There would be a D to 810 and then an E to 650. That's a pretty good scenario because this chart is playing out the way it's supposed to. For the Dow, the alternate scenario would be for the fifth wave down. This would be an A wave ending diagonal. This would be C wave down.
and it would touch 7100 and rally to as high as 7750, and drop an E wave down to as low as 6700 to 6500 to 6700. That's the alternate scenario for the Dow. For the Nasdaq, it would be A wave, B wave, C wave, rally to as high as 1500, and drop an E wave to test 1300. That's the alternate scenario for an ending diagonal, and it's actually, it could actually play out. But if there's a rally in the next couple of days that rallies significantly, at least like 400 points in the Dow. Look at this. If there's a rally to as high as 7750 in the coming days, that would be a possible ending diagonal scenario.
On February 22nd, 2009, major market bottom call Elliott Wave DJI video on YouTube and the bottom call ending diagonal video a week later, I stated the following important points to be able to spot this bottom. Here they are in a list. 1. The Dow was near the precise 0.618 retracement level of the entire move from the low of 74 to the peak of 07, essentially calling the lows of 74 to 2007 wave 1 of wave 3. The crash wave had a 5-wave down appearance of a full corrective wave 2. Back-to-back bubbles in a row, crashes, and finally the Dow gave in and retraced that complete move. 2. We got an upper 2 that was 618 of wave 1, which fits the criteria of that pattern into a downward crash 3. 3. After the crash 3, the key wave pattern was a 382 and an upward 4 before a 5 down. This is very important, like I said, and with 10-day swing trades, I use this exact subject to buy as low as possible. People love to buy low and sell high. This pattern has benefited a lot of traders on websites since 2009. The fifth wave was either wave 1 equals wave 5, truncation, 618 times wave 1 plus wave 3, or any of those three with an ending diagonal. As most people know, I've made some sick midterm bottom calls by spotting this rare and elusive formation. When the ending diagonal occurs at the lowest of the low in a fifth wave, combined with Fibonacci, there's an extremely powerful reversal. Six. The last point was spotting the ending diagonal pattern, which is, again, very hard to see and spot in the bumpy ABCDE low volume whimper. That's what happened in 2009, and I got extremely excited when it happened. ABCDE ending diagonal usually means big profit for you. 7. Finally, right after wave 1 equals wave 5 distance, I spotted the final E wave in the ABCDE, and even called for Dow 6500, S&P 650 to 670, and Nasdaq 1250 to 1300. As you guys know, I called these levels so close to what they ended up being that people freaked out, and the Wavegenius was reborn. The big bottom was in, and it was up, up, and away. Here's a selection of some of my greatest video, Vimeo, and YouTube hits. Prepared to be blown away. Here's the Elliott Wave forecast for October 24th, 2012. First chart I'm going to look at is actually Facebook because the earnings were actually were flat. They only made like a penny on the earnings, but the biggest thing they reported was the fact that they're growing their mobile ads. They're gaining a lot of traction on their mobile ads. And as you know, Google and Yahoo and a lot of the big internet companies are all stating, like, especially Google said that they're falling behind in mobile, and they haven't figured out a strategy for mobile yet, and Facebook has. And that's actually fundamentally, that's very important. That's actually, because if Google isn't doing well, then who is? You know, it's Facebook. And they're up 13% after hours, and they're above the top of the B, or top of the 2 in the fifth wave. And the funny thing about that is, what's so convenient about the earnings report is the fact that since the IPO, it looks like 5 waves down. It's like 1, 2, 3, 4, and 5, and then
It truncated the fifth wave. That's pretty amazing. It's like perfect impulse. 1, 2, 3, 4, 5. I was actually been looking at it, thinking that if it dropped down to like 17 again, I might actually buy it. But I never actually talked about it because I knew it was a risky trade. But now that they reported earnings like this, and the most things though, it's like if Google and like Yahoo and all those companies are struggling to gain traction in mobile, and Facebook has, it's like they're doing something really really good, and Google and all those other companies should be looking at Facebook and how their strategy is developed, and fundamentally that's a big turning point in Facebook stock, and this could actually turn to a momentum stock, and obviously when you gap up like what's going to happen tomorrow, I think it could probably gap up above 23 tomorrow, take out the top of the fourth wave, because it looks like 1, 2, 3, 4, 5, and if it retraces 0.618, you can go back to 32, 33. So this could actually turn into momentum stock in the next few months, and I'm going to be watching it. If it takes out 23 tomorrow, there's a chance of 33.618 retracement, because this is 5 waves down in Facebook. But fundamentally, the news it's a big turning point in the stock, so it's gonna be a stock to watch for the next 3 or 4 months, or at least maybe the next year, because they said that Facebook was no threat to Google anymore. Well, apparently they are now. Anyway, let's go back to.
Here's a midday update for April 1st, 2013. Hopefully this video is not going to be all weird and have 5 voices in it like the last video, but this is the beef of what I want to talk about is Apple right now. This is like a eureka moment, like, oh my god, I can see the chart now. But basically we have A wave, B wave, and within the C wave we have 1, 2, 3, and 4, and then now we're on a 5th wave. What's important is that the drop from 550 to 420 was the retracement in the 4 was exactly 0.382, the downward 3, right on the number, and then before a 5 down. So this could be a 5 down, and if wave 1 equals wave 5, it would target as low as 380 to 390. So a good buy. The best area to buy would be between 380, 390, or sub 400, because this is like clearly A, B, and 1, 2, 3, 4 to 0.382, and 5 waves down. So it goes down to 380 to 390, it could actually retrace back to like 600. So if you're trying to buy for the long term Apple and not worried about the daily gyrations, if it drops down to sub 400, it's a really good buy. That's a wrap. This is going to be the long-term forecast for the Dow, S&P, NASDAQ, Russell, and transports for the weekend of March 16th, 2013. I'll be looking at the 5-year charts and the long-term wave 3 targets of those 5 indices. And what you're about to hear, you'll be like, oh my god, I can't believe what's going to happen. Yes, I'm so excited about these charts. I'm very, very excited about these charts because I don't know how much money I'm going to be making in the next 5-10 years, but let's give it the start of something huge. But anyway, let's go back to 2008 so I can describe what happened. So basically, I called the low of 2009 within about 300 or 400 points in the Dow. Actually, it was actually within like 100 points of the Dow. The video is posted somewhere on YouTube. I'll show it to you in this video in a link. But when we bottomed out in 2009, it was pretty obvious to me that I was going to bottom. It was so obvious to me, at least, and to anybody who's an Elliottician, that we were going to bottom. The reason why is because of this pattern: 1, 2, 3, 4 to 0.382, and a 5. Wave 1 equals wave 5. It was pretty obvious to me that we were going to bottom. So when I made the video to make the bottom call, it was an ending diagonal 5th wave. I actually got within a 1% of the low, of calling the low of the Dow. I don't remember exactly how close I was, but it was really, really damn close. Within a couple weeks, I did the video. Actually, I think it was 2 weeks before the actual bottom, or 1.5 weeks before the bottom. But regardless of when or what I called, I ended up calling the bottom so close to the number of the exact day that it's pretty frightening. Yeah, it's pretty. What I do on my website is pretty frightening anyway. So, in terms of, oh my god, this guy is so amazing. I mean, I'm not saying this to be arrogant. It's the truth. What I do is pretty spectacular. But it was pretty obvious to me in 2008, 2009 that we were going to bottom. 1, 2, 3, 4 to 0.382, and 5. So this is where we start. The low of 2009. Here's the long-term wave count since 2009. Since I believe that we're in a long-term bull market that's going to go to absolutely high nosebleed like levels. You don't understand. You guys don't understand what you're about to see. This is like, it's so obvious to me. It's almost as obvious as the bottom in wave 2, and the bottom that I called in March in 2009. It's so obvious to me what's happening. Here's what's happening. You got the first wave, second wave, third wave, fourth wave to previous 4, and an extended fifth wave into 2011, middle of 2011, and then you got a wave 2 crash. And since I believe this is 5 waves up impulse, wave 2 to the previous 4, and break out to a wave 3, which I believe is the Wavegenius patented, quote unquote, third wave pattern break. Whenever I see this pattern, 80% of the time it happens, and up to 90% of the time it happens. They're between that range, but essentially between 80-90% accurate in calling your long-term forecast is pretty fucking spectacular. Pretty effing spectacular. But again, I believe this is an impulse. I believe this is a 2, and this is a pattern break wave 3. So if this is 1, 2, 3, the highest minimum conservative target would be 1.618 times the point gain of the first wave, tacked on to the low of the wave 2. That turns out that level happens to be 20,593. That is the lowest conservative target for the Dow. But if you go back to the 1920s and look at all the third waves that formed since the 1920s, since the low of 1934 was the low, you'll notice that every third wave, every long-term third wave, was not 1.618 times the point gain. There's 1.618 times the percentage gain of the first wave. You take that percentage gain, multiply it times 1.618, and you take the low of the wave 2, and you multiply that times the new multiplier. In this case, for the Dow, would be, let me calculate this. Alright. Well, my target, I actually drew the target last year, it was 33,346. But let me go step by step of why, of how this calculation actually developed. This calculation is based on this formula. You take the high of 2011, which is 12,800, divided by the low of 2009, 6,500. So basically, it traveled 1.969 times. It actually traveled almost 2 times, or doubled in value, in the Dow from 6,500 to about 12,800. You take that 1.969, multiply it times 1.618. Okay, which the calculation turns out to be 3.186. Then you take the low of the wave 2, which is 10,400, multiply that times 3.186. 10,400, and let me do this again. 12,800 minus 6,500, 63. Did I say 666? Oh, I'm sorry. 6,500. Okay, 6,500 to 12,800 was almost a double, which is 6,300 points. Let me start again. 12,800. Okay, divided by 6,500. I don't do this calculation too often because we haven't seen anything like this for a long, long time. So it's kind of new to me. But let me go through the calculation really slowly again. All right. You take 12,800. Okay, divided it by 12,800 divided by 6,500. 12,800 divided by 6,500, which is a 1.969. So basically, you take the low of the wave 2, which is 10,400. After you calculate this, 1.969 times 1.618 is 3.186. So you take the low of 10,400, multiply that times 3.186 times 10,400, and the target is 33,136. I think the exact low was actually 10,450. So, but my long-term target, if the third wave happens to be 1.618 times the percentage gain of the first wave, is 33,346. Wave 1, wave 2, into wave 3. The conservative target is 20,593, but the highest percentage gain times first wave times 1.618 would be 33,346. I know that sounds insane, but if you again go back to the 20s, look at all the third waves, all the big third waves that formed in the 60s and the 80s and the 90s, and you'll notice that the third waves are not 1.618 times the point gain. they're 1.618 times the percentage gain, multiplied times the low of wave 2, which turns out to be 33,346. Crazy, I know, but people say I'm crazy. But whenever whenever stuff happens, you'll be like, "Oh God, he's not crazy. He's in fact a genius." I don't consider myself a genius. I consider myself more like my eyes can identify things faster than anybody. It doesn't make me a genius, but I think I can spot things with my eyes. This is an art. Elliott wave is an art form. It's not a science. It's a science/art form, but it's more art form than anything. So you have to be you have to have the most refined eyes to see what I'm saying. The eyes have to see all this stuff, and that's what I'm saying. Anyway, for S&P, again, going back to 2008, this is the most obvious pattern to me. 1, 2, 3, 4, 5. That's why it was so easy for me to call the bottom in 2009. It was so easy because I could see this pattern so clearly. 1, 2, 3. The 4 was 0.382 into a wave 5, which is wave 1 equals wave 5. And my target was around 650 to 675, and we got 666. And I called it within a couple weeks, or within a week of the actual bottom happening. Anyway, so we go from this point on. Yeah, calling the bottom is so easy, guys. You don't understand it. It's so easy. I don't understand why people can't see it. Maybe, I don't know. I don't understand it. I think it's so obvious to me, at least. Anyway, the first wave traveled in a 5-wave impulse. 1, 2, 3, 4, extended 5th wave to a corrective 2 to the previous 4. So this is wave 1, wave 2, into a pattern break wave 3. The Wavegenius patented 3rd wave pattern break. So 1, 2, 3. We're in a 3rd wave. So the lowest target I have for S&P, if this 1.618 times, the point gain would be 2305. And we're at 1560 right now. That's the lowest conservative target. So we take this calculation right now. You take 1365 divided by 666. It moved up 2.04 times the low of the low of 2009. You multiply it times 1.618. You take 3.3161, multiply it times the low of wave 2 times 1075. And the result is 3564 in S&P. 3564. So we are not even close to a top. Not even close. I would say we're going to top out at 3564. How about that? That's where we're going to top in like 5 to 10 years. 3564. So again, I keep saying this, but you have to understand. If you look at every 3rd wave going back to the 20s, every 3rd wave, like the 60s, the 80s, and the 90s, every big 3rd wave turns out to be 1.618 times the percentage gain of the first wave, not 1.618 times the point gain. It's 1.618 times the percentage gain. Then you take that percentage gain times 1.618 and multiply it times the low of wave 2. And my calculation is 3564. So yes, we're going to top out, but at 3564 in like 5 to 10 years, okay? Yeah, and Proctor's like, oh, we're ending diagonal, ha ha ha, triple top, la la la. Yeah, he's an idiot. All right, Nasdaq. Yeah, Proctor is. Okay, let me set the record straight. Proctor is a complete lunatic. He's a lunatic, and if you guys mess around with him, you'll lose a lot of money. I'll keep it short and brief. That's all I got to say about Proctor. All right, for Nasdaq. Pretty obvious to me. 1, 2, 3, 4 to 0.382, 5th wave down. My target was about 1275, I believe, in the video that I posted in March 09 or February 09. I have a record of YouTube videos going back to 2006. So this was pretty obvious. 1, 2, 3, 4, 5, bottom 2009 was so obvious. Like I said in this video, it was so obvious to me. I was like, how can you guys not see this? Okay, it's so obvious. 1, 2, 3, 4, 5. So I called the low, the bottom in 2009. So from this point on, you have 1, 2, 3, 4 to the previous 4, 5 extension to wave 2 to the previous 4. So this is an impulse. This is a wave 2. And the reason why I'm calling the 2011 crash as wave 2 is because I'll show you the Russell and transport, and you'll become a believer. You'll become a believer in what I'm telling you right now. But basically, I believe this is impulse 1, wave 2 to a wave 3. So if Nasdaq would travel 1.618 times a point gain, it would be 4869. 48.69, which is not bad. But that's the conservative target. The real target, based on the histories going back to the 20s, and if you take the top of the 2011 of NASDAQ, which is 2880, I believe, divide that by the low of 2009, which is 1287. So from 1287 to 2880, it traveled 2.23 times the percentage gain of the low. Multiply times 1.618, and then you take the low of 2011, which is 2300, multiply that times 3.62, and the resulting calculation is 8327.60839. 8327. That's my highest target for NASDAQ, is 8327. And that happens to be the most common occurrence. 1.618 times the percentage gain of the first wave. 8327. Lowest is 48.69. Highest is 83.27. Now let me go into the beef of what I'm trying to talk about, and plus I'll get into the stock that you want to hear about. That's going to go from 90 to like 1,000 in like 5-10 years. All right. That's why you decided to watch this video in the first place. All right. Let's go to the beef of what I believe is the most spectacular charts I've seen in a while. Not spectacular because they've already happened, but spectacular because they're about to happen. Here it is, Russell 2000. You ready? It's so beautiful. All right, so Russell 2000 got 5 waves down, 1, 2, 3, 4, 5 into 2009. I did not call this bottom because I wasn't paying attention to Russell at the time because it wasn't a big deal to me. But when you see this chart, you'll notice a bunch of things. First of all, there's a 5-wave impulse up, 1, 2, 3, 4 to the previous 4, extension 5th wave to wave 2. But this wave 2, this is what gets me excited because all the bears are calling this pattern an S&P Dow, the 2011 crash, is a wave 4. That is not a 4. It's a 2. You know why? Because the previous 4 the wave 2 touched the previous 4. And that does not happen in a wave 4 at all. And this is a wave 2. This is a wave 2. So you take the top of the formation, 865, divided by the low, which is 348, times 1.618, times the low of wave 2, you get 2,400. I'll be back in 1 minute. Sorry about that. But my cough is I got a cough with acid reflux. I'm trying to get rid of it, plus nicotine. So the resulting calculation is 2,400 in the Russell 2000. 2413.05. Which happens to be almost a triple. And yes, 2,413 is pretty insane in the Russell. But this chart is spectacular for one reason. The fact that the wave 2 touched the previous 4, found support at the previous 4, and then rallied in a third wave. This is not a 4, it's a 2. I emphasize, this is not a 4, it's a 2. So this is a third wave. And so basically 2413, which should be the regular pattern of a third wave in a long-term market. All right. Let's go to the transports. Transports are easily just as spectacular as a Russell. TRAN. So 2008, 1, 2, 3, 4, 5 into a bottom. Pretty obvious. Pretty obvious to me now is that is an impulse in the transport 2. 1, 2, 3, 4, 5. And this wave 2 touched the previous 4, which is so important because I've seen that happen so many times. Wave 2 to the previous 4. It's so frequent that it's like almost like a law. It's so frequent that it's almost like a law. The law of Elliott wave. But I'm fast turning the theory of Elliott wave into a law. But thanks to Prector, he's making it he's making Elliott wave. He's giving Elliott wave a really, really, really bad name. But if people knew about me, if more people, I get like between 25 3,000 visitors a day, and I have like almost 300 subscribers. But I'm just starting, guys. Like, my business is gonna explode. Anyway, I'm making a lot of money right now, but I think I'm probably gonna be like one of those Facebook billionaires. I'm probably getting acquired by Facebook or something in like the next 5 years. But anyway, the first wave transports 1, 2, 3, 4, 5. So you take take the high of the transport, which is 5,600, divided by the low, which is 2,200, times 1.618, 2.545 times 1.618, which turns out to be 4.1185. Multiply that times the low of wave 2, which is about 3,950. Highest target for transport to be 16,268. 16,268. So, if this is wave 1, wave 2, wave 3, the highest target would be 16,268. The conservative target would be 9,500, which is not too bad. It was 1.69 tons of point gain, but since the 1920s, again, like I said, every third wave has been 1.68 times the percentage gain of wave 1. Where's my calculator? Here's my calculator. All right. I forgot to mention the low target for the Russell. For Russell, the low target is 1425, which is not too bad, but 2413 is my target for the standard third wave for Russell. Now we get to the best part of the video. What is the favorite stock that I love? That I would hold on to for a long time. This is why you watch this video. Now that I got all the formalities out of the way, let me show you the stock that I believe will probably be about $900, $900,000 in about 5 to 10 years. You ready? Before I start coughing again, give me a second. Drum roll. Here it is. TNA. Bam. I know it doesn't look like the same impulse as a Russell, but it's a triple ETF, so it has a weird pattern. But since this mirrors a Russell 2000, the TNA mirrors a Russell 2000 3 times the Russell 2000. Okay, it's about 8953 right now. So if it goes from, so 2413 is the top, it would be the peak of Russell 2000 in my opinion. 2413. All right, I'm almost ready. 2413 divided by 925 is 2.60. All right, so if TNA goes from 89, travels 2.608 times an 89.53. Actually, let me see. Let me calculate this. No, from 25. Excuse me. It goes from 27. Sorry. Actually, the low of the wave 2 is 27 times 2.60. Let me calculate that again. Excuse me. Let me calculate it again. I screwed that up. 2.60 is at 952 right now. So 2.60 times 89.53 is 232. It could triple from here. But if it goes times the percentage gain times 3, it could probably... Okay, think about it this way. It's a triple ETF. 89.53 times 3 is about 250. Okay, but if it goes 3 times that, times 3, target would be about 800. So we're talking about $800 to $900 stock in TNA possibility. Because the percentage, because if Russell can triple from here, that means TNA can go up 7.5 to 8 times that. So that's why my calculation is 800 for TNA, based on the Russell by itself. So let me backtrack again. So if Russell goes up 2.6 times, right, and this is a triple ETF. This is a triple ETF times 3. From this point on, from TNA, 89 point times 89.53 would be targeting 700 to 800 from here. So maybe not 900. Okay, according to this calculation, it says 698.334. In either case, okay, TNA could go between 700 and 900 in the next 5-10 years. So this is the best thing about triple ETFs. And not only is it triple ETF, it's a triple ETF of an index, and it's not a company. This is not a company. It's a collection of the basket of companies. It's not an actual individual company. So if earnings come out from one of these small caps and they're bad, it won't affect TNA that badly. It mirrors the the Russell 2000. And you don't have to worry about CEOs dying. You don't have to worry about bad stuff happening to this stock because they don't report earnings. It's just an ETF that's triple the Russell 2000. And yes, that is probably going to be if I can tell, the only people have whenever I talk to them, I tell them what I do. I'm like, I'm an A-list blogger. I make about almost $250,000 a year off my website and blah blah blah. I make a lot of money. They're like, oh, so what are you buying right now? I said, I'm telling you right now, if you buy TNA right now, it'll be about 7 to 8 times the value in 5 to 10 years. I always tell people that. Off the street, at the stores, at the local hangout. I tell everybody, buy TNA right now. And there's a stock, and that's a wrap.
Here is the Wavegenius top 10 stock picks. These are actually the top 10 companies that I found out of any index, any sector, anywhere, and out of the past several hours of research, looking at articles, charts, and many other factors for about 5 hours. And since I woke up this morning around 11 or 10 or 11, I've been researching the 10 best companies. It was actually 20, and it was hard to whittle it down to 10, but based on the chart and based on the fundamentals and based on everything, the top 10 companies that I think in the planet, the best top 10 companies in the entire planet, well, in the U.S. stock exchange, in the U.S. markets. Starting with number 10. Now, if you guys never heard of the stock, it's TSCO, Tractor Supply Company. This redefines the grinding 3. Let's go 5-year chart here. This is 2009. Yeah, this redefines grinding 3. This is a grinder. This is what the market's probably going to be doing for the next 10 years. Grinding like this. Look at that grind. Grind, small correction, grind, correction. Essentially in TSCO, if this area over here is a wave 4, conservatively the highest target would be about 130 to 140. So there's still about 30 to 40% upside in TSCO if this is a 4. But if this area right here is wave 1, wave 2, the highest target I have would be about 225. So it could either double from here or hit 130 to 140 and correct in a wave 2. But in either case, there's still either 30% upside minimum or a double from here in TSCO. If it grinds like it did in the past several years, it has a lot of potential to do that. The next stock is LinkedIn, number 9 on the list, of the top 10 list. So basically, if LinkedIn went from 0 to 120, the highest target, if this is a 2, from 120 to about 58, the highest target I have would be about 250 to 275 in a third wave. This is wave 1 from 0, wave 1, wave 2, wave 3. If we start wave 1 from 58 to 125, the highest target I have would be between 210 and 220 if this is wave 1, flat 2 into wave 3. The fact that it's near its 52-week highs really helps, especially when the market is at all-time highs right now. But again, yeah, if this is wave 1, wave 2, wave 3, highest target would be about 250 to 275. Or if this is wave 1, wave 2, from 58 to 125, wave 2, wave 2, wave 1, wave 2, wave 3, highest target would be about 210 to 220. So in either case, it could be 30% upside or 50% upside. Wave 1, wave 2, wave 3. Very strong stock. Next company on the list is Sherwin-Williams. You're like, what the fuck? Sherwin-Williams, yes. This right here redefines grinding 3. That is a grinder. This is as grinding as you can get. It grinded from 68 to 183, which is unbelievable. This is called a grinder. So essentially, if this is wave 1, wave 2 to a 3 from heaven, the highest target I have would be about, let me see, it started from 20 actually. The first wave was 20, to 85. The highest target I have for Sherwin-Williams would be, bring up my calculator, 85 minus 20. 85 minus 20 is 25 times 2.618 equals 25 times 2.618 equals plus 68. It's surpassed. Essentially, this grinding through your hair has surpassed 3 from Heaven. 3 from Heaven would have been 133, but it's surpassed that by a mile. If this continues to grind like this is a grinding 3. This redefines a grinding 3. Sherwin-Williams. It has surpassed 3 from Heaven, or 2.618. So I really don't. The reason why it's so low on the list, because I don't know where the target is. Essentially, you buy it based on the fact that it keeps grinding up. But since I put it at number 8 because I couldn't figure out where the target was, because it's past a 3 from Heaven. But it's number 8 on the list, so it went from literally 68 to 183 in the past year or year and a half. That's unbelievable. It should be number 1, but I put it at number 8 because I don't know where the target is. Number 7 on the list is ALXN, or Alexion Pharmaceuticals. This is number 7 on the list. What's great about this stock is that it has grinded for a long, long time. Since 2009, it's grinded. With corrections are very, very shallow. But the first correction it got from 120 to 82 was this right here. Could be a wave 2, which is amazing about the stock Alexion, because the correction it had from 120 to 82 could have been a wave 2 until wave 3. So if this is wave 1 from 20 to 120, and it moved 1.68 times wave 1 to above 120, the highest target I have would be about 250. 250. So if this is wave 1, wave 2, wave 3, highest target would be 250. But if this correction to 4, the highest target I have would be about 140 to 150. So either it has upside from here. Well, it's got to break 115 first, or 113. If it takes out 113, all those gigantic targets would come into play. So if it takes out 113, the highest target I have, and a fifth wave would be about 140 to 150, but a third wave as high as 250. So it could almost triple from here, or almost double from here. Yes. Very strong stock. That was number 7 on the list. Number 6 on the list is Amgen. Excuse me. Put 6. Amgen. Another biotech. If we go back 10 years, 11 years, Amgen was actually left for dead for a long time. If we go back to 02, went from 30, let's see, 30 to 84. So, if this is at a 3 from Heaven, highest target would be... So if this is wave 1, wave 2, into a 3 from Heaven, the highest target I have for Amgen would be actually 183. 183. But if this is actually correcting right now in probably a deep 4, so you probably retrace to around 98. But if it can take out 115, that 185 target would come into play. So wave 1, wave 2, wave 3, based on the 11-year chart. That's Amgen. Can you believe that Amgen? Can you believe this? This is Amgen. Like literally from 08 to 2012, it was nothing. It was the shittiest stock ever. It did nothing, and all of a sudden, kaboom! I personally don't know fundamentally why biotech is doing this. I don't know. I've done a lot of research on it. I googled why is biotech on fire, and they can't. There's no specific reason why. You just have to go with the trend, basically. Number 5 on the list is Biogen, BIIB, biotech again. It's up on the list because it got first wave from 40 to 110. So I know this is a small 2. If you start from 40 to 42 to 110 in the first wave, correct it in a small 2. That'd be wave 1, wave 2. Travel from 110 to from 43 to 110. 110 minus 43 equals times 1.618 equals plus 85 equals. So it's actually surpassed 1.618. If this is wave 1, wave 2, wave 3, it surpassed 1.618, which was 190 or 193. It surpassed that. So the next length is 3 from Heaven. 110 minus 43 times 2.618. 110 minus, 110 minus 43 times equals, god damn it. Alright, start again. 110 minus 43, 110 minus 43 times 2.618. 175 plus 85. So if it travels in a 3 from heaven, Biogen, 1, 2, 3, highest target would be approximately 260 to 270. So there's still another 30-40% upside. The reason why this is the highest biotech on the list is because I can clearly see the pattern. I can see wave 1, wave 2, wave 3. And since I have a target of 260 to 270, there's still 30 to 40% upside from here. So Biogen has just gone parabolic. All these biotechs are really, really strong. That was Biogen. That was number 5 on the list. Number 4 is, of course, I know you guys have been watching this stock. It's Visa. Visa is another definition of grinding 3. This is a grinder. This redefines grinder. It literally does not retrace at all. Alright, Visa, the first wave was about 55 points. Times 1.618. I don't like this iPhone calculator is all fucked up. 55 times 1.618 equals 88 plus 65. So it's actually surpassed 1.618 around 155. So if this is 1, 2, 3, 1.618 would have been 155, but it surpassed that. So if Visa's in a 3 from heaven, the target would be 95 minus 40 equals, 95 minus 40 times 2.618. Target would be as high as 210. And the reason why it's so high on the list, number 4, is because I can clearly see a pattern here. Wave 1, wave 2, wave 3. And I can clearly see that it surpassed 1.618. So 3 from heaven would be 210. This is a very, very strong company. 1, 2, 3. So based on this chart, the highest target would be about another 40% upside to around 210 to 220 in 3 from heaven. Yeah, this is Visa. It's a credit card company. It's like, things though, it's almost like it's practically a blue chip. It's like it's a no-brainer. It's Visa because everybody uses Visa, so it's like it's almost a no-brainer. All right, number 3 on the list is the mighty MasterCard. Number 3, MasterCard. This is a very, very powerful chart. So if you start the first wave from about 35 to 315, all right, 315 minus 35 times 1.618 equals plus 110. The highest target would have been let's start over again. We gotta recalculate this. 310 minus 35 times 1.618 is about 450 plus 110. Let's see. Wait, sorry. 312 minus 35 times 1.618. 453 plus 115 equals. All right, so the highest target for MasterCard, if this is wave 1, wave 2, wave 3, was the target as high as 570. So there's still about 5 to 10% upside based on this. But if Visa's in a 3 from heaven, okay, and if we start the first wave from 0 to 315, the highest target would be 315 times 315 times 1.618. 315 times 1.618 equals plus 110. Highest target, if it started from wave 1, wave 2 to wave 3, started from 0 to 315 would be about 620 in MasterCard. But if it's a 3 from heaven, Absolute and most insane target for MasterCard would be 1,000. No shit. Reason why MasterCard is so high on the list is because I can clearly see Wave 1, Wave 2, and I know it's in the third wave. No doubt about it, it's in the third wave. And it's outpacing the market by far, okay? And it's grinding. It's grinding in 3. So the highest absolute target would be about 950 to 1,000 in a 3 from heaven. I believe this is a 3 from heaven because it's outpacing everything. And it's a very, very powerful stock. It's easily one of the top companies in the world in terms of growth. And the chart is absolutely amazing. It's a no-brainer blue chip stock. All right, now for number 2. Number 2 on the list is... I put 2 again. Number 2 on the list is the mighty Google. The reason why I have Google so high on the list is because I can clearly, no doubt about it, see a pattern. First wave went from 100 to 750, 650 points. Dropped in a perfect zigzag to wave 2. So wave 1, wave 2, perfect zigzag until wave 3. And it broke out the top of the wave 1, which is very important because this sets up a long-term third wave. So if Google traveled 650 points for the IPO and went to 1.618, the highest target I have would be 1,300. So this is wave 1, wave 2, wave 3. 1.618 would be 1,300 in Google. But if you start from 0 to 750, the highest target I have would be 750 times 1.618 equals plus 1,500. 1,300, 1,500, or the absolute highest target, the absolute highest target would be 2,000. So 1,200, 1,300, and 2,000 are my targets. The reason why Google is way, way up on the list is because I can clearly see the pattern. 1, zigzag 2, wave 3. That is a no-brainer third wave, no doubt about it. And the targets, 1,200, 1,300, or 2,000. That's why it's number 2 on the list. And number 1 pick is... You'll never believe this. It is... Priceline. Priceline. Do you know why? Because the first wave was 50 to 800, or almost 800, or 775. Got a wave 2 zigzag into a third wave. Got 5 waves up, 1, 2, 3, 4, 5, and a shallow 2. The reason why I love this chart is because it got 5 waves up, 1, 2, 3, 4, 5. Got a zigzag wave 2, and now it took out 0.786 to the upside. So if we can take out 775, the highest target I have for Priceline would be 700 times 1.618. It'd be as high as 1,700. 1,700. If it's 2.618, probably 2,500. Priceline is probably the strongest chart out of every stock that I've seen because it has a clear 5-wave impulse up, clear cut zigzag wave 2, shallow wave 2, clear cut, and it's not taking out the top of the wave 1. And the third wave is the strongest wave. So from 50 to 775 times 1.618 would be either 1,700 or 2,500. No shit. So the number 1 pick, Priceline. Number 2 pick, Google. Number 3 pick, MasterCard. Number 4 pick, Visa. Number 5 pick, Biogen. Number 6 pick, Amgen. Number 7 pick, Alexion. Number 8 pick, Sherwin-Williams. Number 9 pick, LinkedIn. And number 10, TSCO. That's a wrap. Here's a weekly ETF forecast for the for the week of April 21st to 28th. I'll be doing, since this is the first video, I'll be doing a long-term and short-term forecast for UPRO, TQQQ, TNA,
FAS, GLD, SLV, TBT, VXX, SSO, and USO. First chart is UPRO. Say if UPRO was around 20 at the 2009 bottom, approximating, and you got a first wave to run 87. If this is the first wave, the second wave, this is the third wave, the highest target to have for UPRO based on the wave 2 low of 39 in October 2011. If this is third wave, the highest target to have would be about 155 to 160. So if this is wave 1, if you assume that UPRO, if it started trading in March 09, was around 20, and first wave was to 87, and is multiply 1.618 times that number and add it to the bottom of the wave 2. Highest target would be about 155 to 160 in UPRO. For TQQQ, it just started trading in 2010. If you assume that in 09, TQQQ was about 12 to 13, I would assume it was around 12 in 2009, March 2009, had it been trading at the time. So first wave was about 35 points times 1.618, would be about 55. So the highest target I have for TQQQ, if this is 1, 2, 3, would be as high as 80 to 85 in the full upward 3. TNA. Yeah, TNA doesn't. It actually was trading right near the March 2009 low. First wave was 40 points. Second wave was 12. Dropped down to 12. So first wave was 40 points times 1.618 would be 60. So highest target if TNA breaks 47.7 would be 1, 2, 3 would be about 80. Let me see, 5, 40, 60. About 73 to 75 if this is wave 1, wave 2, wave 3 in TNA. For FAS, the triple bank shares of a triple financial. Those are kind of weird. It was actually 160 at the peak and dropped down to like 8. Crazy. You can't call this wave 1, wave 2, wave 3. This is you start wave 1. If wave 1 started at around 15, rally to around 38, wave 1, wave 2, wave 3. Let's see, 15, 35, 1.618. Break out my calculator here. 35 times 1.618. 56 plus 25. If this is wave 1, wave 2, wave 3, and FAS, highest target to have would be about 75 to 80 in a third wave. So there's still plenty of room for FAS to go, for the banks to go in general. 1, 2, 3. For GLD, is a big one. Yeah, this is ABC and GLD it dropped about 35 points, minus 35, was about 137. So it got a little bit beyond ABC in a zigzag. And the lowest target I have, if it turns to a third wave, would be about, 37 times 1.618. 37 times 1.618 equals, wow, minus, you're targeting about 115 if it drops in a downward 3. So far, it's actually beyond ABC, which is around 138 to 140. So a downward 3 could target as low as 112 to 115. About 112 to 115 in GLD. If it turns to a downward 3. SLV, if this is wave 1, if this is ABC from 48 to around 25 would be about 23 minus 37. Wow. No way. Yeah, if this is ABC, the lowest target would be around 14 to 15. So silver could have a way to go, but since this is a zigzag. This you got A, B, and C. So perfect zigzag would be about 12 to 15 in SLV at worst. For TBT, the bond, triple short. I just got TLT. 1, 2, 3. Looks like it has, from 2009, has wave 1, wave 2, wave 3, 4, and probably get a fifth wave. If it takes out 130, the highest target would be about Let's see, wave 1 plus wave 5 would be about 25, 140. So it could be entering a fifth wave. It could be 1, 2, 3, 4, and 5 in TLT. For the VXX, excuse me, not XVV, VXX. That is really impossible. There's no, I can't read 5-year chart on this. So basically, it's going from 1900 to 0. But I think a shorter term look would be more appropriate than a long term chart, because that's a very crazy chart. SSO. If traveled from the first wave 40 points from 15 to 55, it's 40 times 1.618 would be about 60. The highest target have, this is wave 1, wave 2, wave 3 would be about 95 to 100. So there's still a bit more to go in SSO. And for the USO, oh Jesus Christ, that's a pretty messed up chart. Looking at it long term doesn't really matter because this is just a big mess. So I'll skip the long term chart on USO. All right, short term chart for UPRO and all the rest. 1 month chart, 1 minute. Oh wow. So USO could have 1, 2, 3. So if it can rally to 32, but it would stop this downward 3. So it has 1, 2, 3, 4. If it can rally to 32, but if it rises to 32, you can find resistance there and drop below 30.75 in a fifth wave in the USO. All right, UPRO. Looks like 1, 2, 3. No, A, B, C, and then rally. So got an any diagonal fifth wave on ABC. So if you can take out 117.5, it will set up a move above 118.80 and set up a third wave at best. So basically the UPRO may have bottomed here, but we need to take out at least 117.5. TQQQ, ABC, and if it can take out 61.2, a separate break of 62.2 and a third wave at best. But if it fails to break 61.2, you can set up a downward 3. But I'm expecting we might have bottomed last week. For TNA, wow, 1, 2, 3, 4, 5. So 5 waves down, the highest target I have would be about 42 and a 0.618 move. If this is 5 waves down in TNA, FAS looks like A, B, C with a fifth wave ending diagonal. If you can take out 55, or approximately 55, you can set up a break at 56, and probably if we say that if UPRO, TQQ, and all the rest have bottomed here, then we may have bottomed last week, but we need to take out at least 56 to confirm it. GLD, short term, 1, 2, 3. So a 4 would save it if it goes to around 139. If we can ride to 139, this downward 3 would be over. But if we can't hit the 139, it may retest the 130 level, and then break it and drop to as low as 125 to 128 in a fifth wave, or a continuation of a 3. So it needs to ride to at least 138. SLV, 1, 2, 3. There's no 4. It needs to get a 4 to around 23.5, or else this thing is really in deep shit. TLT. That could be 1, 2, 3. If it takes out 123.5, we'll set up a third wave at best, but I have a hard time believing that because if that's 1, 2, 3, that'll be a pretty big move. So 7 points plus 10 would be about 130 in TLT. The VXX, if you guys want to see this, the VXX got 5 waves up into wave 2 minimum. But if it drops below 20.25, it can retrace all the way back to 18, depending on what happens this week. If we bottom in last week and rally, then the VXX is pretty much going to drop down to back to the 18s levels again. SSO, A, B, C, fifth wave, ending diagonal. If we can take out 73, we can test 73.75, and if we take out 73.75, that would set up a bottom. We need to take out the top of the B to confirm it. And for USO, 1, 2, 3. It needs to get a 4. Already, I looked at that one already. All right. If I'm going too fast, let me know, and I'll slow down next time. But I think I may have been going a little too fast, but yeah, let me know if I'm going through the charts too fast. And next time I'll do a video, I will be doing it a lot slower. That's a wrap. Here's the Elliott wave forecast for August 25th, 2010. I know it's been a long time since my last video, but I've been taking a break because the market has been kind of rough. It's been extremely sideways, and finally, in the past couple days, or past a week or two, starting to get a formation which starting to look familiar. The zigzag. Nasdaq 2-month chart. It looks like we got a wave one, and we could be entering a wave two zigzag, and we could be getting the C wave down of the zigzag at least. Of course, the bears like Proctor and those idiots are like, "Oh, we're gonna crash and go down below 1280," and oh, don't listen to them. I mean, this is. I was looking at 20 to 30 top stocks of in the past 3 years, and it looks like a lot of them are just entering wave twos in pretty mild looking versions. So I'm assuming right now that this is just a wave two for now. But if this is a zigzag of the Nasdaq, this would be A. This would be B. A C wave down could target as low as 1850 or as low as 1750 to the downside. If we start sliding into September, October, it was expected though. I was summer has been very sideways and very choppy and just a really terrible summer. But if we get more acceleration to the downside, they could be set up for shorts. But I wouldn't be anticipating a crash, more like a zigzag for now. But the targets I have to the downside again are 1715 to 1850 in the Nasdaq. For the S&P, I mean, it just looks like a mild, like almost non-threatening zigzag. I mean, there's all these threats from all these Elliott wave sites like, oh, we're gonna crash. Oh, I don't. It doesn't look. It looks so mild. It doesn't look all that dangerous right now. But it looks like just a zigzag. But in S&P, it looks like 5 waves up and a wave two zigzag. This would be A. This would be B. And C wave down could target as low as 900 or 875 to the downside. That's as far as I expect it to go. But of course, there was a couple years ago, 2008, when it looked mild, and then we had a big crash. But there's no bubble that's deflating right now. I mean, there's no housing bubble. The housing bubble's already deflated, and like commodity bubble is deflated. I just don't see a crash for the Dow. I mean, it looks pretty mild right now. Just like a zigzag. I mean, you can like. Okay, let me put a little rationality behind this. If the Dow dropped approximately 7,000 points, or 8,000 points approximately, if we drop 8,000 points from where we are right now, that would be Dow 2,000. But that would have to be the end of the end of the freaking world. Like, and that's what Proctor wants, and he's just a complete maniac. I mean, it looks like it's a mild wave too. It doesn't look all that dangerous right now. I mean, the news that's coming out isn't all that threatening. It's not like a gigantic housing bubble that just started to deflate. It's deflated. Look at the HGX. Look at the 10-year chart of the HGX, the 5-year chart of the HGX. I mean, this is what happened in 2007, 2008. Yes, we had that big crash. That's a third wave. Okay? This is the housing chart. This is wave one, this is wave two. Of course we're going to get a really big crash because this is downward 3. Then we got an upward 4. In the worst case scenario in the housing market, we get a downward 5. So we could be nearing the bottom of the housing market. I mean, look at this. It's so clear cut. Wave 1, wave 2, wave 3, wave 4, and wave 5 that could truncate and not hit a new low. I mean, of course you're going to get a downward 3 crash because of this. This is a downward 3, but there's no downward 3 here. I don't expect a downward 3. If we had a downward 3 from here in the housing market, it would go down to 0. That means that there'll be no houses in this world.
just be rational for. You guys gotta be rational for a change because like if you expect a crash of just Dow 2000, it's just stupid. It's just the most moronic thing I've ever heard in my entire life. And all we're getting from practitioners like, oh, Dow 2000, roar, roar, roar. Don't listen to this idiot, okay? It doesn't look that bad for now, but I just don't anticipate anything worse than a wave 2.
Here's the noon update video for October 12th, 2011. I'm going back to the 3-month charts because longer term there's resistance levels that are approaching pretty quickly. Anyway, for S&P on a 3-month chart, we may have completed a full zigzag, with the C wave being about 0.618 of the wave A. So we've got AVC completed because we're approaching 1242 or 1232, which is the full 100% retracement of the entire drop from 1232 to 1080. If you break 1232 in S&P, the 0.6 retracement of the drop from 1370 to 1080 is 1257. That's 0.618. But if you check out 1300, I would officially declare this to be at the end of the bear market. 1300 is about 80 points away from where we are right now, but 1300 is about 0.786 of the drop from 1370 to 1080. So I'd officially call this the end of the bear market if we break that level, 1300. For the Dow, we got A, B, and C finally, and the rally is approaching the 100% retracement of the drop from 11,720 to 10,400. So if we break 11,720, 0.618 would be about 12,000, and then 0.786 would be about 12,250. So if we take out 12,250 in the Dow, I'll officially call this the end of the bear market. But it's still kind of early to call because we still have resistance levels coming up. But if we can break those levels, 12,250 and S&P we break 1,300, I would call this the end of the bear market. For NASDAQ, the big level is 2750 or 2762 precisely for NASDAQ of the drop from 2888 to 2300. So if you break 2762 in the NASDAQ, I'd officially call this the end of the bear market. 2642 is 100% retracement of the drop from 2642 to 2300. So once you break that level, if we break that level, first level resistance is 0.618, 2663, and then after that 2762. So levels to watch are 2663 in the Nasdaq, and 2750 in the Dow, and the 2762 in the Nasdaq. So again, I would call this the end of the bear market if we break 1300 in the S&P, if we break 12,250 in the Dow, and for Nasdaq we break 2762. That's a wrap. Here's the Elliott wave forecast for November 2nd, 2011. On the S&P 3-month chart, it looks like we completed 5 waves up. It'll be wave 1, wave 2, wave 3, wave 4, and wave 5. And what gave it away was the fact that the wave 5 was 0.618 times wave 1 plus wave 3 right on the nose, which was 1292. And we're correcting at least a wave 2. So I'm anticipating at least a drop to around 1190 to 1200 to complete this wave 2. Hopefully just a wave 2, because 0.618 is around 1155. So the worst case scenario is that we test 1155 or the previous 4 around 1190 to 1200. But I'm anticipating a test of the previous 4 right now around 1190 to 1200 to complete a wave 2. And hopefully it's just a wave 2. And it does have an impulse. It got the impulse of 5 waves up with, again, the 5th wave, 0.618 times wave 1 plus wave 3, and then we drop in a wave 2. For NASDAQ, previous 4 support after 5 waves up, 1, 2, 3, 4, 5, is around 2550. And 0.618 is around 2475, 2450. Actually around 2475, 0.618 for the NASDAQ. So the two levels that need to hold are 2550 and 2475 on NASDAQ for it to be just a wave 2. then it needs to rally back over 2750 to set up a third wave. For the Dow, got 5 waves up, 0.618 times wave 1 plus wave 3, wave 5, and then dropping up into possible wave 2. We're probably going to test around 11,300 at worst, and 0.618 is around 11,200 approximately. So we need to hold those 11,200 to 11,300 and then break out above 12,250 to set up a third wave. That'll be wave 1, wave 2, and wave 3. And we're entering a seasonally good period, so hopefully the seasonality helps push the market up. But where the effect of the Greece mess isn't over yet, and it's probably started again, it's going to make it kind of hard. Because this market is driven by fundamentals, and when fundamentals break down, like what's happened with the Greece today, it's kind of unknown. But hopefully that gets resolved in the next couple of days. We have the Fed meeting, and then we have the unemployment report in the next coming week. Tomorrow's the Fed meeting, so hopefully we get a good reaction off of the Fed meeting. That's where we're at.
Here's the Elliott wave forecast for November 9th, 2011. I'll be looking at the long-term wave counts for the Dow, S&P, and NASDAQ. And if you're a perma bear, you won't like what you're about to hear, because when I see these patterns, they occur 80 to 85% of the time. And on record, I've seen this pattern on record in the past 11 years. Every time I've seen this pattern on the long-term charts, the setup actually occurs. And we get not only a breakout, but a 1.618 times wave 1 move. So basically on the Dow 2-month chart, we got wave 1, which is almost 2,000 points. And you got a wave 2 that retraced back to near the previous 4. That'll be wave 1, wave 2. And if this is a third wave pattern break, if we break above 12,275, this is wave 1, wave 2, wave 3. And the third wave is 1.618 times the 2,000 point move almost in the Dow, which I think is like 1,900 points, times wave 1.618 times wave 1. The highest target I have for the Dow would be as high as 14,700. It's not a crazy target because, again, the Dow traveled almost 2,000 points off the lows from 10,400, and we got a retracement wave 2 and a pattern break wave 3. So if we take out 12,275 in the coming week or coming days, again, the highest target I have for a third wave would be as high as 14,700. And it's not a crazy target because every time I see these patterns develop like this on a long-term chart or a 2 or 3 month chart like this, the third wave targets actually occur 80% to 85% of the time on record from what I've seen, like on my website. If you look at my record. I'm not kidding. And when you see it so clear cut like this, like NASDAQ rallied 450 points almost off the lows, almost 450 points off the lows, retracing a wave 2, and broke out in pattern break wave 3. It hasn't broken out yet, but 2752, if that breaks, that would set up a third wave. And if the third wave is 1.618 times wave 1 times a 450 point move in the NASDAQ, highest target I have would be 3280. 3280. That's 1.619 times wave 1 plus the bottom of the wave 2. And it's not a crazy target because we got a wave 1, wave 2. And the wave 1 was really large, and we got a wave 2 and a retracement wave 2. And then now we're on a pattern break. Whenever I see this pattern, guys, the full target happens 80% to 85% of the time. If you look at my PDFs from stocks in, I believe it's 09, 2010, and 2006, I believe. I did long-term counts for in 2007, 2008, which were correct as 75 to 85% of the time, I believe. I haven't checked those 2007, 2008, but I didn't do one 2008. But I did one 2007. I knew there was a big drop coming, and I called the. Actually, it was the middle of 2007. Anyway, that's besides the point. The point being is that every time I have
that I've seen this third wave pattern break occur, I get the full upward 3 target, and it usually hits. So I'm not even kidding. This is it's so pure. It's like wave 1, wave 2, wave 3. They take out 2752. Highest target I have would be 3280 in the Nasdaq. For the S&P, I mean, there's a chance this is a 4, but I'm looking at this as a wave 2, a quick 2 before a 3. And if this is one of those quick 2s that goes back to the previous 4, and this is a third wave pattern break, and the third wave travels 1.618 times wave 1 times the 220 point move in the S&P. If it travels 1.618 times wave 1, the highest target I have would be as high as 1570 in the S&P. That'd be wave 1, wave 2, wave 3. We need to take out 1292 and then obviously 1370 first, but we take out 1295 approximately. That would be 0.786 of the entire drop from the 52-week high to the 52-week low. And we're right on the edge of really exploding to the upside. I'm talking like big third wave that takes out new 52-week highs and takes out the 2007 highs as well. So, I mean, I'm not saying that this is 100% accurate, but it's pretty close. It's like wave 1, wave 2, wave 3, okay? It's like, I literally have made these I've made hundreds of charts of like 2-3 month charts, 6 month charts, 3-year chart, 5-year charts, and when you get this pattern, wave 1, wave 2, wave 3, and it occurs 80% to 85% of the time. I'm not kidding. From my record, and I'm seeing it now, so I'm not. I wouldn't ignore this video if I was a bear, because I'd be scared out of my mind if I knew that this thing was going to go to 1570, and I can continue to add to my short position. Why would you do that? This is a setup for a third wave. And, okay, the worst case scenario is that this is just a 5th wave and this is a 4th wave. But if there's a possibility that he could travel 300 points from here, from an S&P, 300 points at least, that's a scary thought, because not only would you go bankrupt pretty quickly as a short and keep on adding short positions here, it actually hurt a lot. I won't say you go bankrupt, right? But the margin call will be pretty big if you keep on adding. But all I'm saying is that this it's not 100%, but it's pretty close. Wave 1, wave 2, wave 3. Do not ignore this pattern, because the third wave is sitting just around the corner, and it looks so clearly defined to me. So I'm not. I really would like to say this is 100%, but 85% is pretty scary when it comes to calling a chart pattern correctly. That's a wrap.
You've come this far. Now, shh. Here's my new 90% trading strategy. People usually do not go this far, and now I'm saving the best for last. Here's what I typically want my new trading pattern. 5 perfect waves up, completing the stock. Get the first wave down. Second wave or upper B retraces near or exactly 0.618 for the wave 1. The third wave down is exactly 1.618 times wave 1, or even 2.618 times wave 1. Shh! Here's the most important part. The fourth wave up retraces exactly 0.382 for the third wave, not 0.236, not 0.500, or the BS that people come up with. I'm talking exactly 0.382, if not exactly 0.382, pretty darn close to it. And the final step, we get any one of my numerous 5th wave patterns. This 5th wave has to subdivide into 5 waves and form an ending diagonal, truncation, or standard 5th wave. That's wave 1 equals wave 5, or 0.618 times wave 1 plus wave 3. At times, you can use the RSI. If the long-term chart has an RSI for the stock 20 or under, that's another bottom predictor that I use frequently. Yes, you cannot buy the bottom of a C wave in a wave 2 zigzag. Here's what's required. The A wave subdivides into 5 waves. The B wave is exactly 618 of the A wave, or again, pretty darn close to it. The C wave is exactly equal length to the A wave, or pretty close, and subdivides into 5 waves. The overall market, like the S&P Dow and Nasdaq, must be following the same pattern. When A equals C, buy the bottom of the C and buy the upper 3 retracement. I rely less on the zigzag formation to buy. However, I like to buy the bottom of 5 waves down, typically because of their purity, like wave 2 equals 0.618, wave 3 equals 1.618 times wave 1, and wave 4 is 0.32 of wave 3. I get pretty excited. These trade setups have worked 22 out of my 25 trades in 2011. The little pattern break. Yes, it's a 5-wave pattern. You buy 5 waves down now. It works like magic. 90% of the time. I don't even remember when I have lost. I've never had a loss this year with this pattern. So, yes. Okay, here's a list of what not to do. If a stock is in its own little world and is not following the S&P Dow Nasdaq, don't bother. Never ever assume that a large gap down on earnings is a third wave down. I guarantee bottom fishing coverage talks like this is a bad idea. The third wave down must not occur in a gap down, and it has to follow the overall market. Has to. If you have to see wave 1 of wave 3, wave 2 of wave 3, wave 4 of wave 3, and 5 of 3 clearly, if you don't even think about it. Here is what Wavegenius.com has to offer.
I'm dancing